It's agreed to buy Deutsche Bahn's logistics unit. They beat CVC in the race to acquire this business. DB Schenker, we're talking about here, the private business. And it turns the Danish firm into the world's largest freight forwarder. So certainly one that we will continue to watch, Guy.
Okay, here we go, the Friday session. Friday the 13th. I'm going to point that out once again. We are expecting a little bit of a tick higher in the session today. The debate really around central bank rate cuts is one that we are watching carefully, but there's a bunch of single stocks, as Anna says, that may have an impact this morning. But we're expecting a fairly flat open. That is largely what we are getting. The FTSE 100 is out of the gate. A little bit of green on the screen, but not much. Keep an eye on what is happening with the mining sector, but also what is happening in the healthcare space this morning. Deutsche Bank out with a series of ratings downgrades that could affect names from Roche to AstraZeneca. The stock 600 is up by 0.2%, but the FTSE 100 looks like it's struggling in and out of positive and negative territory. The IBEX is up by 0.2%. We'll see how Germany opens in just a moment. The CAC 40, as with other markets here in Europe, not on an index level, delivering very much. But Critty, you promised action below the surface. What are we seeing?
It seems to be concentrated on the downside in AstraZeneca, and that seems to be your biggest index weight when we're talking about that, of course, coming from perhaps the downgrade you saw in the ADR specifically. Anna was mentioning that as well. Remember, you also have a downgrade over in Roche, getting cut to a sell over, I believe, at Deutsche Bank as well. So you're going to see biotech seemingly under pressure, and surprise, surprise, that's exactly where you're seeing the underperformance. You're also seeing it in travel and leisure companies, Anna, when you look at some of the downside moves. Besides that, Marshall moves to the upside. That Friday feeling showing up in the stock market this morning.
Yeah, just delving into the travel and leisure to see. There we go. Ryanair is the one that is down the most. We're talking about a move of 0.9%, so not huge.
There was a move yesterday. So it was the AGM yesterday. O'Leary's out talking about the fact that we're going to see a downside on fares of 10% in the winter, which is kind of pushing. He was a bit equivocal last time I spoke to him, but he was definitely pushing at the AGM yesterday the downside on that fare story. Now he's got to deal with the Boeing strike as well.
So there's a lot, yeah, so we're certainly looking for any read across there. We do seem to see a bit of it. Then it's the Boeing story, but it's other things as well then perhaps in the mix when it comes to Ryanair. At the top of the pile, in terms of those sectors, we've got financial services, but that seems to be a fairly mixed bag of names and not one with a huge amount of news flow behind them, perhaps. It's an interesting day, isn't it? We're waiting for something, waiting for clarity next week, I suppose, on the 25 or 50 debate.
Can we talk about this kind of diversion that you're seeing in the pharma space, really? Roche and Novo Nordisk seem to be the outperformers this morning, despite Roche getting cut, of course, over at Deutsche Bank. AstraZeneca is taking the hit. I don't know if we can put Sanofi.
Sanofi, so GSK, they're all down.
They're all down, but then you have some outperformers. So I'm struggling to find what is the decisive factor in the biotech space right now. It's a tale of two pharma, perhaps.
The healthcare sector as a whole is up, as are most sectors.
The market likes the DSV story. So it looks like the market seems to be there's getting quite a good deal there. The stock's up by 3%.
Another example of an acquirer going higher. That's an interesting mindset that the market seems to have adapted in a number of different sectors in September.
Yeah, because we saw that in Unicredit with Commerce Bank yesterday as well. I also wonder if complacency is a part of it. We've been keeping our eye on Vodafone shares as well, given the UK CMA provisional findings as well. Those shares also higher by 0.4% this morning. Again.
Rolls is down, Safran is down, Airbus is down. So there is a Boeing effect that appears in the market as well this morning as we get news on that strike. In fact, 8 o'clock means midnight in Seattle, which means that the union has just walked off the line at Boeing at a number of different facilities. I think 33 gates are going to be seeing action this morning. They've been preparing for this strike action. So we're going to see lines at a number of different locations up and down the coast over in the United States.
So as we await updates on that situation, let's go right back to the macro, because there's plenty going on, of course, in the last 24 hours. The debate of whether 50 should or actually be back on the table. And what are the conditions that maybe support that? Mohammed El-Arian, our Bloomberg opinion columnist, weighs in. Take a listen.
We have a major reconciliation in our future. We have the treasury part of the fixed income market that is signaling quite a high probability of recession. We have the credit part of the fixed income market that is signaling a very high probability of a soft landing. Now, if liquidity doesn't reconcile these two things, there's going to be even more volatility in this marketplace. And at some point, volatility spills back to the real economy.
Let's stick with that topic. Madeline Ronner joins us this morning, portfolio manager over at the global equities team at DWS. Madeline, a pleasure to have you on the program. Let's pick up on that concept of volatility. This morning feels a little bit lackluster on the surface. We're seeing more volatility underneath. But if there's a conversation on the macro front of 50 or 25 or a volatile easing cycle than perhaps the economy has been used to in the last couple of decades, how does that show up in the markets?
So I think volatility generally will continue over the next few months, where we struggle with this. Okay, will it be a recession? Will it not be a recession? How will the Fed react and handle this? I actually think 25 basis points would be better. So if we get more into a gradual easing cycle, that signals more to me that it's just inflation under control and less worries about the economy, because that is in the end, I think, what matters most to stock markets. Like, why are the rate cuts happening? Is it because the economy is too weak and needs supporting, or is it because we have conviction that inflation is fought? And I think a more gradual easing cycle is more what signals that, okay, it's inflation that's gradually coming down. We feel comfortable with that, and we're moving in a very controlled manner back to a more lower target rate.
Well, Madeline, we keep hearing this a couple of buzzwords here. We hear volatility, we hear uncertainty, we hear geopolitical and election risk, not to mention what's happening specifically over in the States. And I'm curious what the hedge is against all that, as opposed to just waiting on the sidelines and having a more cautious approach.
So I think one thing because investors can position is more on the defensive side. So what we have seen already since July about this year, that defensive names like in healthcare and utilities, for example, they have started to perform better. And also I would expect that to continue at least until the election. So I think that's a way to position yourself on the equity side.
Can I ask about where you see the best opportunities at this point, Madeline, in terms of growth? Because you talk in your notes about China. You can't rely on China. It's unlikely that China will help the world economy, you say. So therefore, focus on the US consumer. So what kind of pivots out of what and into what, in terms of sectors or stocks, do you do if that's your view of where we go from here?
So I think you have to balance really, okay, where do you see the most growth and where valuations are really attractive, right? Because the market has kind of fled into the areas where you still see good growth momentum, and so valuations there are really high. So what we like is kind of the balance of both things. So for example, we still like the European stock market simply because valuations are much more attractive. We see earnings growth coming back here over the next 2 years. We see actually earnings growth from the Magnificent Seven and from the US as well as Europe coming closer together, which should help performance. So this is something that we like. So growth in general, yes, you mentioned it. So the focus is really much on what the US consumer is doing. So China is this time not helping. I think this is really a regime shift from other times of economic weaknesses that we have seen, where really China was always helping because they were just growing so much. They were helping the global economy. This time that's unlikely to happen because they themselves are so weak. So we see that with steels. We see that with EVs, for example. They're trying to export that to a weaker global market. We see the oil print yesterday also, where you had like the fourth year-over-year decline in China oil demand. So that's really weak. Europe on its own will likely not lead the recovery. So it's really dependent on what the US consumer does. So also what happens next week with retail data, I think, is really, really important for the market. And that's where you see the most growth, but valuation there also a little bit stretched. So
okay, and we'll watch the UMISH number later on today as well, with that in mind. So do you get excited about banks, Madeline, at this point, and the European banks and the possibility of consolidation there? Is that a theme that you are looking at closely?
Yes, so we've liked European banks actually for the course over the last year, and we continue to like them still even into the easing cycle, because we think just with the hedges that they have, if it's a gradual easing cycle that's not too fast, they're still relatively well positioned. With regards to consolidation, I also think, I mean, obviously in the German market there is more room for consolidation. I think generally with regards to a European banking union, also cross-border consolidation is something that's very interesting. So let's see how this progress shapes out. I think it's very, very interesting what's happening there currently. I find it really hard to believe that the German government was really caught that off guard by this. I mean, for once, you like when the pricing came, you really had no discount, even though there was the departure of the CEO announcement. So that was really unusual, where you would usually have like a large buyer. And then on top of that, I mean, he was on an interview yesterday here. A 9% equity stake in itself is quite punitive on capital requirements for UniCredit. So I don't think that it's very likely they will just want to keep that stake. So the move really here, what they want to do is quite obvious, even if they wanted to keep all options open, or he wanted to keep all options open in the interview. But I think that's where the direction is headed, and we've not heard yet officially what the German government is thinking. But he also said what I thought was quite interesting, that he would not have made this move if he thought that the German government would be opposed to it. So it will be really interesting to see what happens there going forward. We had some other banks also prior to that already be interested in a potential deal here. But obviously, UniCredit is now in a pole position. So it will be really interesting how this shapes over the course of the next month.
Madeleine, if I want to buy Europe, if I think Europe is a place to be right now and it's going to close the valuation gap with the United States, do I need to see Europe acting in unison on things like cross-border deals in the banking sector, in finding new ways to deliver funding, to deliver the green agenda, to deliver the kind of growth story that Europe so desperately needs? I'm trying to reconcile the kind of the economic story and the political story, and what Draghi said and what is happening in Germany with the politics and what's happening in France with the politics. I'm trying to make a compelling case for why you want to buy Europe, and how much of that is built on the foundation that Europe is going to act in concert rather than as a bunch of single entities, i.e. single states.
Yeah, so I think if Europe would manage to act in unison and implement some of the policies that Draghi proposed, I think that would actually be additional upside, because then the European economy in itself would be better, right? But why we like European equities is more because, I mean, a lot of the European stock companies, they're not that dependent on Europe itself. They're global companies. They're tied to the global equity risk premia, right? So if we go into the recession, obviously, you would not want to own Europe. That's not our base case. Our base case is actually also in the US, that risk of a recession is there, but we will have a soft landing. And in that case, European stock markets are really tied to that global risk premium as well, and growth and EPS growth as well. So I think if we manage to get some policy reforms within Europe to act in more unison, to have better funding, to also do some structural reforms with regards to policies and like companies to ease more quickly, to have more innovation, I think that would actually be additional upside. So we're coming more from the angle, you have solid earnings growth, not phenomenal earnings growth, but solid earnings growth from the global side already. And on top of that, you have more attractive valuations.
Is the dismal China story in the price enough in Europe? Is it priced into the auto sector significantly? Is it priced into the luxury sector? Are we seeing enough of a hit from China to make us believe that actually, if China continues with its dismal growth story, Europe has already factored that into its equity prices?
I think so. I think that's factored into valuation. So if you look at how the European equity market traded over the last 2 or 3 years, so the discount really increased disproportionately. It's now trading on a forward PE on a 60% discount. So that's quite a bit. And I think a lot of that is due to the weaker China environment, and obviously that China historically has been a growth driver for Europe, and that's now just weakening. From a stock selection basis, yes. So companies that have been really dependent on the Chinese consumer, I think they will have have tougher times ahead. I think they will have to seek out new growth opportunities in different end markets, because while I don't think it will get much worse from here, we have the Chinese Consumer Confidence Index now approaching the lows from the pandemic. So I don't think it will get much worse from here, but I don't see it getting better quickly either. So still cautious on large China exposure, and obviously on the automobile industry, we've heard a more negative news flow recently too. Some of that is structural, some of that is tied to the EV transition, to China demand and all of the tariff dispute that we have there as a European Union with China. And some of that is just more temporary issues with the brakes, for example. So that's two different angles, but also difficult environment for the automobile industry here.
Interesting to hear Olli Rehn talking this morning about how concerned they are that actually more of the growth issue in Europe is structural rather than cyclical. Madeline, thank you very much indeed. Madeline Rohner, Portfolio Manager on the Global Equities team, joining us from DWS. Let's take a look at the core six here in Europe. What are we watching? What are we seeing? These are the numbers, as you can see, broadly positive. But if you actually take a look at how positive we are seeing these numbers, it's a fairly mixed picture. The luxury sector is a little bit more positive this morning. There's a really mixed picture within the healthcare sector. Novo is up very strongly, but you are seeing Astra under significant pressure. Chip stocks elsewhere a little bit more muted. Nestle up by 0.2%. There's significant M&A in the markets. There is a rating story in the market this morning. Let's get the details with Joe Easton.
We want to actually take a look at the payment processing sector first, because we've got a big profit warning over in France this morning out of Worldline, and that stock getting absolutely hammered in Paris, down 14%. At the moment, they've announced that their CEO is stepping down as well, and they've halved their organic growth guidance for the year ahead. A big shock for that company today. It has had its own restructuring issues as well, but we're seeing a bit of a read cross coming through into some of the other payment processors as well. So the likes of Nexi over in Italy down 3%. Adyen not doing too badly, but clearly a move in Nexi as well. That shock profit warning from Worldline having a pretty big impact today. Then we'll check in on those Boeing affected stocks that we flagged earlier today. Airbus, not too bad, up down around 0.2% at the moment. Safran, unchanged at the moment. But the one standing out is Senior PLC here in London. Now, bear in mind, this is a company that's only got a market cap of around £600 million, but it is really dependent on Boeing, and therefore that stock down 4.4% at the moment. That was one of the worst performers in the UK as those Boeing workers go on strike moments ago over in Seattle. Then in terms of software, difficult one to read given we had Adobe and Oracle going in separate directions in terms of the post-market moves after their earnings results. Actually some green on the screen, not doing too badly, maybe feeding it through from the US overnight with potential focus on the Fed and easing that kind of thing. So tech doing okay today. Capgem up around 0.7%. Down in Paris at the moment. Then in terms of deals, a couple of things that you've been flagging on the show already. Vodafone, there is that news of the CMA looking at that deal with 3 Mobile, saying that in fact it could lead to higher prices for some customers. The company is actually saying they kind of agree with some of the comments from the CMA, so they're going to try and address that. So the stock pretty heavy for that one. DSV up another 2%, pretty impressive. It was up 10% yesterday on reports of that massive logistics deal going through, about 14 billion euros in terms of value, up another 2% for that stock over in Copenhagen. Then back to the ratings changes. We mentioned earlier AstraZeneca, and that one is declining as Deutsche Bank cuts to sell following that weak lung cancer drug data earlier this week. So it's now got 3 sell ratings, down 1.6% in London. And just to touch on Roche, Deutsche Bank did cut that one as well, but going the other way, Bank of America, they've upgraded Roche this morning. Bank of America says that concerns around the obesity drug portfolio are actually overdone. The weight on that stock is overdone because the core oncology profile is still really strong for that company. So that one actually rising 1.5% in Switzerland today.
Joe, thank you very much. Joe Easton from our equities team. We heard a lot from the ECB yesterday. We're still hearing a bit from the ECB this morning. The French Central Bank Governor Villeroy making comments about inflation, sounding a little bit dovish, saying that we must be attentive to the risks of undershooting the target. The pace of ECB rate cuts has to be highly pragmatic, he goes on to say. But yes, they should continue their gradual approach. I mean, we heard a lot from the ECB, but really Christine Lagarde not wanting to commit on any future policy moves.
I kind of hope they were always highly pragmatic, but anyway. we'll park that one. Within the last few minutes, Boeing's biggest union has gone on strike. The latest next, we'll talk about the impact not only in the United States but around the world, particularly the impact here in Europe. That's next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is about respect. This is about addressing the past. And this is about fighting for our future. Our members rejected the contract by 94.6%.
John Holden, the leader of Boeing's largest union, speaking a few hours ago, this after confirming that the union will commence strike action. It has now done so at a number of different plants up and down the West Coast in the United States. 33,000 workers are going on strike. The decision comes as the plane maker, of course, struggles to recover from a series of manufacturing missteps. Let's talk to Bloomberg aviation reporter Danny Lee about what is happening here. Danny, let's talk about what Kelly Ortberg does next, and he's the new CEO of Boeing. How quickly can Boeing and the union get around the table again, get a new deal out to the union that the union members are going to accept, because Boeing can ill afford this to carry on for much longer?
Yeah, that's right. I mean, this is a new low for Boeing, considering all the things that have happened to it over the past several months, and the fact that Kelly Ortberg was brought in to fix all the issues that are piling up for Boeing. This is going to be a true test of his resolve, his ability to show that for the board who hired him, how quickly he can fix things, because he had a strong track record at his previous company. So what can he do to perhaps personally intervene and knock some sense into the previous negotiating talks to see what more can Boeing offer, frankly. The 25% over 4 years, clearly not enough for the workers, particularly the fact that their annual bonus was being taken away. So there is a lot of anger there when you look at the strength of the results and the rejection of the deal that Boeing put on offer here. And I'm sure for Kelly Ottberg, there'll be a lot of concern, not just from the workers who are looking for a new deal, a new settlement, but also for the airline customers who will now not get their planes perhaps as soon as they wanted to, already delayed. And we've already seen frustration from the likes of the biggest customers like Ryanair saying that they will not having enough certainty of what kind of planes they'll get and when. So clearly there'll be pressure building on multiple fronts here, and that's just on the commercial aviation side.
Danny, 19% of Boeing's workforce represented by this union. You mentioned that 25%. They were asking for 40%. It doesn't sound like they're getting close to a deal. What does that time horizon look like?
Well, this is going to be fascinating to see how quickly Boeing is willing to bring forward more proposals. And its tone in its statement only a few hours ago, it seemed open to finding a resolution, a path forward. And clearly from the union side, they are very, very clear from the union head that there was many parts of the deal on offer originally that were not acceptable. So I think clearly it's going to be critical just to see what is put forward quickly. But a twist to this earlier, the announcement was the union filed an Unfair Labor Practices Act. So this will go to federal arbitration. And so what this means is this will become a more long drawn out process. This is something that Boeing doesn't want, because ultimately the last time it struck in, the union struck in 2018, that cost $1.5 billion a month. And clearly with Boeing's finances being much more fragile, they would rather not see a higher cash burn at this time.
Yeah, talking of fragile finances then, Danny, this is a business with a fairly heavy debt load, and it's watching its debt rating very carefully. That's got to be a worry. Yeah, no, absolutely. And given what we have seen, the fact that right now production stops on its commercial jets, commercial aviation, the revenue that accounts annually is around 40 to 45%. So with all the production that will stop from that, the impact, how much that builds in terms of pressure, the fact that it will not have cash coming in from all the planes it is supposed to deliver. Yes, there'll be a backlog going forward, but they'll be losing time and losing money from the targets that they had tried to strive to hit. So therefore, the pressure that builds will be enormous.
Danny, this clearly will have an impact at Boeing's factories, but it'll also have an impact on the supply chain. The supply chain has been so important to this industry over the last few years and the struggles that we've seen within it. Talk us about how this will ripple through the global economy.
Well, I think for the airlines in particular who have anticipated these delivery of Boeing planes, which are already delayed, it hurts, at least on the travel front, the fact that airlines can't grow as much as they want to, as quickly as they want. I think there is a frustration from the supply chain side that a key component of what they do to build, to deliver to Boeing, that may now stop. But we're in the early days here. If we find a resolution in maybe a week or two, that's a lot better than the 50-odd days that it took in 2018. So clearly the time is ticking on getting something resolved a lot quicker.
Danny, great stuff. Thank you very much indeed. Some great coverage coming out of the aviation team here at Bloomberg on this Boeing strike. Danny Lee joining us on that story. Coming up, Ralph Schlossstein is going to be joining us, Evercore Chairman Emeritus and BlackRock co-founder. Lots to discuss. Politics, the economy, what's happening with deal flow, all of that on the table next with Ralph. This is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is the opening trader at 30 minutes into today's session across Europe. You are seeing green on the screen, and you're seeing some momentum pick up, Anna. You're higher by 0.6% on the Eurostoxx 50. The FTSE 100 still lagging a little bit. The biotech story, AstraZeneca certainly weighing on that market. But across the continent, green on the screen, some outperformance actually in the DAX, higher by 0.7%.
Okay, so some gains across European stocks. Let's pivot to the U.S. economy right now and get some perspective there. Wilbur Ross, the former U.S. Commerce Secretary under Donald Trump, told Bloomberg where he thinks the U.S. economy is heading.
I think the U.S. is heading toward probably a very mild recessionary period. And that shouldn't be too surprising. It was artificially propped up by all the rate situations that had prevailed and all the cash that was pumped into the economy in the aftermath of COVID. I think they overdid that.
As Wilbur Ross, former U.S. Secretary of Commerce under Donald Trump's first administration, they're talking about a very mild recessionary period. That's his expectation. Let's get another perspective on the U.S. economy and on markets, on deals, and much beyond. We're pleased to say we're joined by Ralph Schlostein, Evercore Chairman Emeritus and BlackRock co-founder. Ralph, really nice to see you this morning. Welcome to the studio. Thanks very much for joining us. Let's start with your sort of in-the-moment market expectations. There's a lot of people wondering whether we're going to get a cut of 25, 50 basis points from the Fed next week. Seems to matter. I wonder if, in the grand scheme of things, that's the sort of thing that matters to you because of the signaling it might give to markets. What are you thinking?
I do think it does matter. And if I were in the room, I would actually be pushing for a 50 basis point rather than a 25 basis point cut, not because I think the economy is on the verge of recession, but I think the balance of risks has shifted from a risk that inflation doesn't come down as we hope to a risk that unemployment and grows up faster than we would hope, and employment doesn't grow as fast as we would hope. And as a result, I think the argument for moving toward neutral is a pretty strong one.
Okay, so you're in the 50 camp.
Yes.
Would that be, would a 50?
I'm not saying they'll do that.
Sure.
I'm saying that's what I think they should do. Yes.
So if we, is there a danger though that if they did 50, that spooks the horses? Would this be taken as risk on or risk off, do you think, by markets?
I think I believe the right thing to do is 50 for two reasons. One, I think the balance of risks are more in the slower employment growth. And second, we're quite a ways away from neutral. The risks, even if they are balanced, we should be closer to neutral. And I think a path which starts at 50 rather than one that goes 25 and then 50 actually communicates a more relaxed view about how the economy is doing right now. Whereas if you started at 25 and then in November did 50, it would actually spook the market a little bit.
Good morning, Ralph. So just listening to that, you're fairly confident that a 50 would not signal that we're in a hard landing?
No, I think, we're so far, obviously when we were at 0, we were a long way from neutral.
Yep.
At 5.25 to 5.5, we're also a long way from neutral. And if the risks of slower employment and inflation are roughly balanced, we should be closer to neutral. And to me, the statement should be, we now have balanced risks. If anything, we have a little more risk that employment is going to grow too slowly, and therefore we should be getting on with the path, getting to neutral.
Just to break it down a little bit, which bits of the U.S. economy do you think need rate cuts right now? Is it the private sector? I look at company margins; they look fantastic still, really good. Is it the employment story, or is it the government that needs a rate cut right now?
Well, the government benefits from a rate cut, but the parts that I think need a rate cut are the rate-sensitive sectors like housing and smaller business, where all of their borrowing is tied to short rates, prime, lines of credit, et cetera. And so, and by the, big business is doing great. Margins are high, top line growth is decent. So I don't think the case is, in the S&P 500 or the Dow Jones. The case is in the part of the economy that actually generates the vast majority of new jobs.
How much of that strength, though, is at the whim of what might happen in the political space in the next 6 months? I'm curious, if we're talking about these interest rate cuts and this resilience, how much should the Fed be thinking about the continuity or the potential increase of tariffs in the next 6 months?
Well, the Fed would always say that they react to the economy, not to fiscal policy or to trade policy. And I think that's basically true. I think we're in a period right now of significant economic uncertainty. We're in this transition period from when inflation was too high and it's now coming down. It hasn't quite reached the Fed's target yet, but it's certainly moving in that direction. And unemployment is drifting upward. And, as you just heard from the former Commerce Secretary, there certainly is, some risk that we will have not a soft landing, but a mild recession. All of that means there's uncertainty. The political period adds additional uncertainty, and so that's kind of a chilling effect on significant moves by business.
Well, Ralph, famously in 2019, Jay Powell basically announced an insurance cut to address the pain from tariffs, which is why I'm wondering if that playbook sees a little bit of a repeat, and if tariffs are even something the market and the economy has gotten used to, or maybe is the budget perhaps the bigger worry?
Well, I think you have to separate what I would call trade balancing or tactical or targeted tariffs and blanket tariffs. Blanket tariffs, I think, presage, and high tariffs presage a period of declining free trade, which we've already entered somewhat, and that is inflationary and very bad for markets. So if that happened, I think we'd certainly see an effect in the markets. The impact in the economy would be, always uncertain.
Well, we're already seeing, you mentioned the difference in blanket tariffs and target tariffs. We're already seeing that kind of a continuation of not just the Trump era, but even in the Biden era, a continuation of tariffs, not just on China, but on Europe as well. At what point is that so damaging to the economy?
Well, the magnitude of them has not been that great so far. And I think as a general matter, the Biden administration has tried to balance, what they would call fair trade and a reasonable relationship with Europe and our allies in Asia, and not a whole-scale attack on free trade. Being the special trade representative in the Biden administration has probably not been the most exciting job over the last 4 years.
Yeah, maybe. Let's talk about areas of the market that might be exciting and talk about deals, because that's something I'm sure you have views on. We're just seeing another example this morning. Digital Bridge sets away the sale of a $4 billion firm EdgePoint. Just another example of maybe some deals going through. We heard from Barclays this week, Goldman Sachs this week, both saying things are starting to pick up on the deals front. Wishful thinking or actually seeing evidence of that?
Well, there's definitely some pickup in the announced activity. If you look at the first 8 months or so of this year, the dollar volume of announced transactions is up. Interestingly enough, the number of transactions is still down this year. There's, if I look at Evercore's business, we track a number of indicators. The least forward-looking is our backlog, which is tangible. The other measurable ones are new engagement letters signed. Earlier than that is new conflicts clearance, when a client calls us up and says, hey, we're thinking of this, will you help us? And even earlier than that, which is not quantifiable, is active dialogue with our clients. The active dialogue with the clients is way up. New engagement letters is up. And conflicts clearances are up somewhere in between those two. So there's definitely a significant amount of pent-up activity. As we talked earlier, we're in a period of economic uncertainty. Economic uncertainty is the enemy of announced activity. So it's going to happen. It's a question of when it really starts.
Do you think the Harris camp is generating economic uncertainty? We don't know yet what the Harris camp is going to deliver in terms of its economic agenda. We seem to be light on detail. What is your sense of that? Well,
I'm not sure if I had a scale here, and I watched the debate on Tuesday night, which I did at 2 a.m., that if going down was, on the one side, was how specific was the candidate in terms of their economic policy. I'm not sure that the Trump side would go down more than the Harris side. So I think that both of them are trying to say as little specifically so that they don't offend anyone. I actually think she's been more specific than he has, at least in the last, since she's entered the race. So I think the fact that these are two very different visions for America, definitely, and it's a toss-up, definitely injects uncertainty. But I wouldn't put her policy as being a principal contributor to that uncertainty.
Well, you talk about her specifics. Her campaign has certainly outlined, as she has as well, in terms of a continuation of the Biden policy, which is tackling drug pricing. She's talked about grocery prices, housing affordability. Economists and investors would listen to that and hear that and be concerned about that being a recipe for stagflation. Do you agree?
No, I don't. I think that there are two elements to her policy. And by the way, I am a Democrat, so take this all with a grain of salt. I think there are two elements to her policy. One, it's a torque the benefits of our society a little bit toward the middle class and those less privileged. And I think her policies on housing affordability, drug prices, child care, and the child tax credit all are geared there. And you know, there's going to be a massive debate next year about the extension of the Trump tax cuts. And I think the biggest difference between these two is the position that they will take on that, whereas Trump is for extending all of them and for, in fact, expanding some of them on the corporate side. And she is clearly for expanding all of them for those below $400,000 in income and cutting back on the corporate side. She's proposed 28% rather than 21%, and probably eliminating some of the cuts that are beneficial to the most wealthy in our society. I think it's a policy focused on a little bit of retorquing toward the middle class and below, and a growth agenda.
The counter argument of that simply would be that the Trump tax cuts did great for the economy. Jamie Dimon has made that point. A conversation for another time. Ralph Dawson, we have to leave it there. Evercore Chairman Emeritus and BlackRock co-founder, we thank you so much for joining the program. Coming up, we go right back to the deal space. Ralph was talking about that as well. This time in the UK, two major Vodafone deals are under regulatory scrutiny in the UK and Italy. The company's CEO of European markets joins the program next. Stick with us. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. forget that it's just in China, it's in a very small area. I think that's very risky.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. Let's dive into some news around deals this morning. The UK's antitrust watchdog says the Vodafone 3 deal raises serious competition concerns and says it risks harming consumers. We're joined now by Vodafone's CEO of European markets, Ahmed Essam, who has been overseeing, from a Vodafone perspective, the merger. Ahmed, really nice to speak to you. Let's dive straight in then, shall we? The CMA seems to be concerned about a number of angles here, and one of them is around pricing. What can you tell us around pricing? Any wider guarantees you can offer the CMA on that front, especially as you're going to have to do a lot of investment to improve the network, and that might assume increased prices. What can you tell us on the pricing front?
So good morning, Anna, and thank you for giving me the time to speak to you today. So it's important really to speak about what sits at the heart of this deal. And what sits at the heart of this deal is a once-in-a-lifetime opportunity to really transform the digital infrastructure of the UK. We will invest 11 billion of our own money to make sure that we build the best mobile network in the UK. This includes bringing 5G to every town, village, school, hospital across the entire length and breadth of the UK. We worked closely with the CMA over the previous period. And it's important to say that what comes out in this report is provisional findings, meaning we still have next steps to go through as we approach a final conclusion on the 7th of December.
Okay. Ahmed, are you assuming, though, that you mentioned there 11 billion you're spending, better 5G coverage, but are you assuming then that customers will pay more for that 5G coverage?
No, we completely disagree on this point in terms of pricing. We believe the market is competitive as it stands, and we believe that with this proposed merger, we will bring more competition into the market. And competition is not only based on pricing, it's also based on quality. And I think where the UK lags today is on quality, and we will address this through the merger. We believe this pro-competitive merger will drive even further competition in both the retail and the wholesale market.
So, Ahmed, it's Kriti in London. Just to confirm, are you saying that you're not planning on changing your pricing?
Yes, and we've clearly said that, Kriti. Thank you for this question. We've clearly said there is no proposed change in any of our pricing strategy. If you look at the heart of this merger, this proposed merger, it's really an investment case. It's an investment case that brings a bigger, wider infrastructure. We will have a lot of more capacity. We're more than incentivized to compete rather than take the prices up. So that's really what we believe, and that's what we've explained to the CMA. We disagree with the pricing conclusion that comes with the CMA, but also will work closely to address any of their concerns over the coming period.
Well, I'm sure you can understand the CMA's concerns that if you do control more of the infrastructure, you have more of that ability naturally to change your pricing. And I hear what you're saying and appreciate that you have no plans at the moment. But what might change that? What might change? What circumstances might change your thinking around increasing pricing?
I think the only constant that has been in our industry, and everybody would see this, is with new technologies, with new investment, what comes is a lot of capacity. And what consumers have experienced throughout the previous period is mobile accessibility has been more and more affordable over the previous years. You can expect more of this with this merger, because this merger, we made a number of commitments in this merger. The first one was the 11 billion of investment. When we make this 11 billion, we're willing to undertake a legal binding commitment to really underpin this execution in the market and deploy all the sites required. We also made another commitment of trading radio waves and spectrum to one of our competitors that will elevate the experience on their side. So there are many commitments that we've done. we're not expecting pricing to go higher. In fact, we are expecting the price to become more aggressive and more competitive post-merger, because now we have a lot of capacity. We have a bigger network. We have more of an incentive to fill it and drive more activity on it, rather than just take the prices out. That's why we disagree with the CMA on this point.
So you disagree, but how big a surprise is what we've heard from the CMA this morning? Was this largely in line with what you would have thought would have come out?
So it's a really good point. So I understand and I appreciate the point that's coming out of the CMA on pricing, and we need to work closely with them to address any of their concerns on this front. But most importantly, I think when you read the provisional findings, you will find also that the CMA acknowledges that there is a quality improvement that comes out of this merger, and this quality improvement is important for many of our customers, and we positively see this. They also see the value of the investment going into digital infrastructure that is required for the country. So there are many things that we see as positive out of this merger, and I think it's quite visible when you look to the scale of this investment. It's not every day where you get our own money going into such a big investment. There is no need for taxpayers' money to come and cover a gap later on. When you look to UK ranking today, we really trail behind the rest of Europe, and this is a once-in-a-life opportunity to get there. The concerns will be addressed over the coming period, but we expect the final conclusion on the 7th of December, and we're confident that we'll be able to work as close as we can with the
So you think you will get to a deal by December the 7th, which, as you say, is when the final deadline is. So what gets us there? What are you going to have to do? What remedies are going to have to be changed? What are you going to do to make sure that on December the 7th we are good to go?
Yes. So, as I said, I think the first commitment is on how do we make sure that the investment that we're putting in is actually going into the right places, is legally binding, and we're deploying where it matters, and we're willing to do this. The second one was on the spectrum trade or the radio waves that we're doing with one of our competitors. And then the third one will be working closely with the CMA to address their concerns and find possible solutions as outlined in the findings today. We're not. It's not right to kind of speculate now on what the solutions might be, but I'm confident we'll be able to work with this to get to this conclusion.
Ahmed, you talk a lot about the infrastructure story. One of the cases or one of the concerns from the CMA is that your case for infrastructure is overstated. What are they missing?
I think when you actually look into, and I was hearing the message from Stuart as well this morning, I think the CMA might see that we might not be willing to carry on with this investment. That's why it's really important that we underpin this with a legal binding agreement to make sure that this network investment is really going on the ground and going to be executed. So we're willing to take this commitment, and we've highlighted this previous on. I think the impact of it is really transformational, because the experience that we're seeing in the UK today is far lower than where it should be. At the far end of the plan, what we get to is more than 90% population, more than 95% population coverage of 5G standard. The coverage, there's a big part on digital divide today. There are many rural areas, rural towns, where you don't get as good coverage as you should. And we will be able, through this merger, and we've done the modeling on this, and we can show this to the CMA and Ofcom, is that this will address the entire length and breadth of the UK. We will be able to address
Ahmed. Sorry to interrupt, but we're just coming up to a break. Ahmed, thank you very much for joining us. Ahmed Essam, putting forward Vodafone's case, of course, Vodafone's CEO of European markets. We will see how this plays out then into December, when the CMA is expected to make its final decision. We see the DSV share price is up by 1% today. Coming up on the pulse, Francine speaks to the CEO of DSV, which just purchased Deutsche Bahn Logistics for over 14 billion euros. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg. Former New York Fed President Bill Dudley makes the case for a half-point cut as fresh U.S. data sustains expectations for the Fed to actually trim next week. Now, Boeing's largest union says no to a deal. 33,000 workers are now on strike, adding another headwind for the troubled plane maker. Plus, the Danish company at DSV becomes the world's largest freight forwarder after agreeing to buy Deutsche Bahn's logistic unit. We'll be speaking to Jens Lunds, DSV's chief executive, and that's at 9:30 a.m. UK time. But first thing is first, there's a lot going on in the market, so let's get straight to European markets map. Again, it's a big central bank week. It has been because of the ECB. Next week will be an even bigger one because of Fed. Now, the CAC 40 can see 0.2% higher. Similar gains for the DAX. The FTSE here is actually practically unchanged. Now, cross assets, there's an interesting thing, and we'll spend a little bit of time talking actually about gold. So I look at two things. First of all, euro dollar. This is probably a bit of a Fed story, but also a euro story on the back of the ECB. I'm very happy to be speaking all about this with Emos Fiotakis. And then S&P futures practically unchanged. Gold, you can see on the rise, 2,569. Now, Boeing factory workers also walked off the job, crippling manufacturing across the plane makers' Seattle commercial jet hubs. Members of its largest union actually rejecting a contract offer and voted to strike. The walkout began at midnight Seattle time, and you can see Boeing down 3.1% pre-market. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Joining us now, Emos Fiotakis, Global Head of FX and Macro Strategy at Barclays. Paul Dobson, our Executive Editor for Asia Markets, also joins us. Good morning to you both. Emos, there's a lot going on. When you look at Fed expectations, are they getting too much ahead of themselves, or is not enough priced in?
No, I think that they are probably going a little bit ahead of themselves, at least relative to what we know now, and more importantly for FX, relative to other central banks, including the ECB. Yes, the economy is slowing, and yes, we are at this period of time where the market is just trying to calibrate exactly how much the Fed will cut by, but our take on the overall economy is not for some kind of emergency, kind of quick, fast-paced cutting cycle.
And Paul, what's going on actually with gold today?
I think gold is getting a lift based on those Fed expectations. It seems like a dollar down day pretty much across the board. We also saw that reflected in Asian strength today across the currency markets. And I think that calculus is, just as we got to the point where pretty much everybody was expecting that the Fed would do a 25 basis point cut, along comes that slight possibility that they'll do 50 again. And that weighed on short-term yields in the Asia market session and weighed on the dollar as well and gave gold that big boost as a result.
I mean, Themos, look, as you say, the Fed is likely to cut rates next week. What's your view on the rate path afterwards? Is that a lot more uncertain, and what does that mean for the dollar?
Well, first of all, let's just say that whether they do 25 or 50, it's going to have a near-term impact, but it's not going to change the course of humanity.
It's good to remind, it is good to remind markets that.
Yeah, and the second thing I would say is that to us, committing to a 50 basis points pace, because if you start 50, you're not going to be doing just 150 probably, right? Committing to it's unnecessary, and also like Bullard said, what's the point in that? You can always accelerate later if the data deteriorates. So we are sort of like in the 25 basis points camp. But even if they did the 50, right, there was a point in time around the payrolls report where the market briefly priced 3 times 40 cuts for this year. And euro-dollar was at that point a little bit above 111. So I doubt that we're going to have an enormous impact on the 50.
And Paul, I know that there's, of course, we'll go back to actually some of the dollar reads, but actually when you look at yen and what the Bank of Japan has made or hasn't made clear, how will that, Paul, drive markets forward?
I think that's one of the crucial currency crosses to watch out for. The Bank of Japan, of course, still hiking at the same time as all the rest of the central banks around the developed world are cutting interest rates. And so that is giving the yen that support relative to the dollar and relative to other currencies as well. Now, surveys are suggesting that the most likely time for the BOJ to do the next hike is December. We do have a meeting coming up very soon, and we might get a little bit more of a steer on that. The next most favorite month is October, and if we do see the BOJ leaning into that some more as a big possibility, then it may give the yen some more strength. And we're seeing that in the FX options space in trading this week. There's been people picking up those opportunities to try and capture the risk of a stronger yen over the coming trading sessions.
Themos, have we seen the worst of the yen carry trade unwinding, or is there still more to come?
I think that in terms of the very sort of like forced nature of the selling of the market, I think that a lot of that is behind us. Yeah. Now, if you think about the fact that the Japanese typically invest abroad, if we were in a setup where there's a lot of repatriation, there could be some of that. But I think that the worst of the forced carry trade unwind is far behind us. If anything, speculative positions are now long yen.
What do you think overall is the most underestimated risk in the currency markets?
At the moment, I think that one of the most underestimated risks in the currency market is tariffs and China. We are a little bit ahead of the election. Asian currencies are trading strong. There is the risk of whatever probability you give to that, of a 60% tariff looming, which would have an enormous impact, I think, on the economy and on the currency market, which is not priced.
All right, Themos, thank you so much. Paul Dobson, Bloomberg's executive editor for Asia markets. Thank you as always. More from Themos Fiotakis from Barclays shortly. Now, Bloomberg has also learned that the ECB Governing Council members believe they aren't yet in a position to rule out a rate cut at their next meeting in October. Now, this comes as policymakers weigh any downturn in the economy as underlying inflation projections nudge higher.
The risks to economic growth remain tilted to the downside. Lower demand for euro area exports, owing, for instance, to a weaker world economy, or an escalation in trade tensions between major economies, would weigh on euro area growth.
Well, joining us now is Lizzie Burden, who's in Frankfurt for us. Good morning, Lizzie. So where does the cut to growth forecast actually leave interest rates in October?
Well, this is the big question, Francine. Do they squeeze in another cut in October before going back to this quarterly pace of quarter-point cuts? And markets don't see it as very likely. They've cut the chance of an October cut from 40% before the meeting to 20% now. And that's despite the dovish signals. You had, as you say, the cut to the growth forecast this year and in the years ahead, the fact that Lagarde said the risks to growth are tilted to the downside, but didn't mention a bias on inflation. And then this morning, the ECB speak, Muller saying that confidence is growing, that inflation's slowing. Wren saying he sees question marks around the growth outlook. Nagel saying he sees inflation calming down. Simkus saying more cuts must happen, but then Villeroy and Muller flagging the inflation risks. Of course, as well yesterday, Christine Lagarde very much sticking to this data-dependent, meeting-by-meeting messaging, saying essentially don't overreact to individual data points because inflation could come down, but it could go back up again. So at the moment, it seems that economists and markets are agreed. October doesn't look likely, but as you say, officials emphatically not ruling it out.
Lizzie, thanks so much. Lizzie Burden there in Frankfurt. Let's get back to Themos. Themos, we also heard from François Villeroy de Gallo, the French central banker today, basically saying, we must be very careful not to overshoot and undershoot inflation because it's their only mandate. But it's very difficult to calibrate it, given geopolitics and given all the uncertainty with oil as well.
For me, I think that the risks are more tilted to the downside in terms of European rates, in terms of the European outlook, and as a house as well. Europe is being hit by slowing China growth, by a trade war, which is not going to happen. It's already happening. It's years now happening. We see that in a number of sectors getting affected by what China is doing. And this is going to continue. It's going to extend, regardless of who's the next U.S. president. Ongoing escalation will continue. You have domestic demand, which is hit by higher rates. And it's pretty clear that there are very transitory factors around inflation, which are likely to abate. So for me, I cannot understand how we are in a setup where we're debating a series of 50s for the Fed, but for the ECB, we're very ambivalent, basically, as a market.
But so why is that, actually? Is it just because there's a perception in Europe that inflation could pick up, or there's not an overheating of the economy?
No, I think that to some degree, you need a stronger message from the ECB to some degree, I think. And I think the biggest issue with the ECB, which confounds people and it's puzzling, is that the countries that are most challenged in growth outlook and are likely to have the biggest challenges also in terms of how growth filters to inflation are the ones that are the most hawkish at the moment. So it's the most confusing bit, I would say.
What does it mean for Euro?
I think it's just a matter of timing in terms of the realization that European rates in real terms, for instance, are quite high versus where the U.S. rates are priced at the moment. And that probably means that beyond the near-term euro strength, which could extend for a couple of months, euro-dollar is probably going lower in 12 months out.
But so when you look at interest rates and where they should be in 18 months, is that a good benchmark? And are we going to see a big rate differential between ECB and Fed?
I think that differential has narrowed down a lot. So, for instance, if you look at 10-year real rate differentials between Europe and the U.S., it's the tightest it has been in the last 2 years. But that, to me, I think that there will be a point in time, the first couple of cuts, where U.S. growth will stabilize, where the outlook will stabilize, that will get repriced higher, and the challenges for Europe will remain, and their outlook will get repriced lower, and the wedge between the two will widen.
Why are markets not starting to think about? I mean, President Trump is talking about possibly debasing the dollar. We worry about possible Fed independence being put in question if he becomes president. The market doesn't latch on to that at all. Is it because it's far-fetched or because they don't know how to trade it?
I think the costs to having Trump interfere with the dollar are very high for him. So he can actually do fiscal retrenchment, which he won't do. He can actually issue debt to buy foreign assets, which is unfathomable in the U.S. context. Interfering with the Fed, his selected appointments in his first presidency got shot down by a Republican Senate. So it doesn't seem that it's the easiest thing to do.
Okay, thank you so much. As always, Themos Fiotakis, their global head of FX and macro strategy at Barclays. Now, we're just getting a big piece of news. I'll try and figure out exactly what it means, but China is now fining PwC and has halted operations over its Evergrande audit. I mean, Evergrande is something that we've been talking about for quite some time, and I think at some point Chinese policymakers had actually employed PwC to come and have a look. They were basically parachuted in to run this scandal hit business, and at the moment, just in the last couple of seconds, China has fined PwC but also halted operation over these audits. We'll have plenty more news when they break through the Bloomberg terminal, and as soon as I have them, I'll give them to you. Now, Adobe plunged post-market after its revenue forecast failed to reflect an AI uplift. Oracle also surging as investors cheered its long-term sales target. The company expects its annual revenue to rise to at least $104 billion in fiscal 2029. So you can see actually Adobe down 8%, Oracle gaining almost 5.8%. Coming up, Boeing's Seattle workers ignore a plea for peace from new chief executive Kelly Ortberg, downing tools for the first time since 2008. We get the latest on this developing story. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Now, Boeing's factory workers have walked off the job for the first time in 16 years this morning, crippling manufacturing across the plane maker's Seattle commercial jet hub. Now, it comes after members of its largest union rejected a contract offer and voted to strike. For more on this developing story from, of course, let's bring in Bloomberg aviation reporter Danny Lee. Danny, thank you for joining us, as always. So what's at stake for Boeing, really?
Yeah, good morning, friends. So, this is a new low for Boeing, frankly, given the pressures it has financially after what has happened over the last several months, particularly all stemming back to this Alaska Airlines door blowout. These unhappy workers, 33,000 of them, is a resounding vote of rejecting this deal that Boeing had thought it had negotiated a good deal with its union leadership. So where do we go from here? Well, frankly, we're only hours into a strike, the first strike in 16 years, and so for the factory, the biggest factory for building its commercial jets out of Seattle, down in tools, and therefore no new planes will be finished and be built, and no planes can be handed over to airline customers around the world. And that puts pressure on Boeing because it can't take in the cash from all the planes it is building and all the costs that goes into them. And so for new CEO Kelly Ortberg, that pressure, not just on getting a new deal, a new negotiation settlement for the unions that they'll be happy with, investors as well, as we see pre-market Boeing stock being down, and then also for airline customers who'll be angry that yet another piece of disruption is hitting them, and the fact that they may not now receive planes as when they said they would, which has already been delayed.
So, Danny, what exactly, I mean, how much impact could this have? What kind of disruptions? And you were mentioning the new chief executive. I mean, this must put them under a lot of pressure.
Yeah, no, absolutely. And I think that now that with Boeing, new CEO, he has come in, been parachuted in to try and clean things up for Boeing, he now has a chance to try and fix things and show how good he is in getting a new settlement. You know, this was not necessarily his deal, but one where he can now come in and try and put things right, something that has been long in the making for 16 years.
Danny, thank you so much for the terrific update. Our Bloomberg aviation reporter there, Danny Lee. Coming up, new capital rules for UK banks. We'll hear from Sam Woods, Deputy Governor of the BOE and head of its regulatory arm. That's next, and this is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Now, the Bank of England says it has made significant changes to plans for bank capital rules that will mean key requirements are virtually unchanged for UK lenders. Now, I asked Sam Woods, the head of the BOE's regulatory arm, about the response from the industry.
The main objective of the package, both here and elsewhere in the world, is to make sure that we're measuring risk correctly in the banking system, and it makes a number of improvements in that regard. But it does do two other things, which I think both of them are relevant to your question. One, it shows that the UK is a strong upholder of global standards, because this package will meet the standards set by the Basel Committee. That's very important for financial stability and cross-border trade. But also, we have had close regard to UK competitiveness and growth. And we've made a number of targeted changes to speak to that point. And just stepping back one pace, if I might, this is also the first major piece of banking regulation we've done since we left the EU. And I hope what people will see is we're taking a balanced approach. So we're resolute in maintaining financial stability, having a strong banking system, but we're also very mindful of competitiveness and growth issues, and will accommodate those to the extent that we can.
Do you think this actually does make UK banks more competitive?
I think there are some changes that we've made versus what we've proposed on which definitely go in that direction. And in particular, there were quite strong concerns expressed about the plan we had to remove something called the EU support factor for SMEs and for infrastructure. And we will remove that, but we'll make an offsetting adjustment in another part of our capital requirements, which I think is just a more intelligent way to handle it. So it's things of that kind where we've moved.
So, it coincides also with the new government in charge. Did that come into your thinking, or was it lobbying from banks?
Well, look, I mean, of course, banks lobby extensively on a thing like this, and lobbying is sometimes used as a dirty word, but this is a part of the policy process that people have an interest, get engaged. Our approach to that is we're interested in evidence. So where banks bring us convincing evidence that we've got it wrong, then we act. Great example of that is we've also done a thing on trade finance. So we've reduced something called the conversion factors, which is how much undrawn commitment, if you like, clients of banks might pull down when certain things happen. And we've gone out with one level, and the banks gave us some evidence which was very convincing, actually, that was overcooked for trade finance. So we made that change. Now, that's also good, I think, for UK growth and competitiveness, but it has to be based on the evidence.
But since 2017, because this was the last set of rules, how have banks changed? And do you see more risk going into, for example, shadow banking and unregulated parts of the financial industry?
So it is true and oft discussed that there's plenty of risk outside the banking system, and sometimes that blows up on its own. Sometimes it blows up, as in the case of Archegos, for instance, which was around the time you were talking about, and brings a big hit back into the banking system. So we have to be aware of that from a macro-prudential point of view on its own grounds, and from a micro-prudential point of view in terms of its impact on the banks. But look, let's not forget that the banking system serves its purpose partly by taking some risk. And so we shouldn't forget there is also significant risk in the banking system. And this package does not increase the overall amount of capital by very much at all. But what it does do is move the capital around within the banking system so that it's in a better place.
But this makes UK banks more competitive compared to the US. And we had a number of proposals also from the US this week. Were you briefed ahead of it so that you could almost calibrate?
So we've been in close touch with our US colleagues at all levels in our organisation, including at mine, and we have been talking, as you would imagine. I think it's very helpful that Michael Barr made his speech on Tuesday of this week, both because I think the substance, at least to me, looks very sensible, but also, perhaps more importantly from our point of view, there's a very clear commitment from our US colleagues to go ahead, and this is an international agreement, only works if everyone plays.
Well, that was Sam Woods, the chief executive of the Prudential Regulation Authority, talking to me about the BOE's new bank capital reforms. Coming up, we'll be speaking to the chief executive officer of DSV, which has agreed to purchase Deutsche Bahn's logistic business for over 14 billion euros. That conversation is up next, and this is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Former New York Fed President Bill Dudley makes the case for a half-a-point cut as fresh U.S. data sustains expectations for the Fed to trim next week. Boeing's largest union says no to a deal. 33,000 workers are now on strike, adding another headwind for the troubled playmaker. Plus, the Danish company DSV becomes the world's largest freight forwarder after agreeing to buy Deutsche Bahn's logistic unit. We'll be speaking to Jens Lund, DSV's chief executive, in just a moment. Also, a story that we broke about 20 minutes ago, China has actually halted some of PricewaterhouseCoopers' business for 6 months in the country for its role in auditing China Evergrande Group. Now, the company, we understand, was fined some $62 million. That's according to statements from the Ministry of Finance over in China. PwC definitely under the spotlight after China launched one of the biggest investigations of financial fraud in history. Now, the other story we're watching out for is Boeing. Factory workers there have walked off the job, crippling manufacturing across the playmaker's Seattle commercial jet hub. Well, members of the largest union rejected a contract offer and voted to strike. The walkout began at midnight Seattle time. DSV has now agreed to buy a Deutsche Bahn unit in a $14.3 billion euro deal, actually, that will turn the Danish company into one of the world's largest logistics companies. I think we're joined by Jens Lund, the chief executive of DSV. Thank you, Mr. Lund. I'm so happy to see you online. So first of all, congratulations on the deal. It's a massive deal, and thank you for joining us today. So what are your main objectives strategically with this deal?
Our main objectives with it, thank you for having me here, first of all, and our main objectives is to create basically the world's strongest player in our industry. We're going to be a global leader, and with the combination of DB Schenker and DSV, we will have basically the best service offering in our industry.
So can you quantify any synergies or any loss of commercial opportunities? I don't know if certain clients, because of the overlap, will go elsewhere. How do you quantify these right now?
Normally, when we integrate companies, we manage to get the efficiency of these companies up to our level. And this means that, of course, at the end of the day, there will be basically job cuts. It's not something that we've detailed 100% out right now, so we'll be able to give specific numbers later on. I think when it comes to top line, actually, I believe that once our customers they experience the stronger offering we have, we will actually be able to grow our volume, and we will not lose volume. It might be that there will be some customers where we have too large a share of wallet in integration, but that is part of our planning, and we should soon be able to overcome that.
So, Mr. Lund, what do you see as a financial outlook for the new company? Again, do you know how much revenue you're expecting to increase in coming years?
Yeah, if you look at the company right now, we will have approximately 40 billion euros in revenue, and that can dip a little bit, but then we're going to grow faster later on. So I think we will probably pretty soon be about or above the 300 billion DKK or 40 billion euros in revenue, and then grow faster than the market. This has been normal when we acquire companies that this happens, and we also expect that this will be the case for the DB Schenker deal.
Do you have any plans to shut down units? I know you mentioned maybe early days, but job cuts seem to have been one of the tricky points in negotiating this. So what's your deal with that?
Yeah, normally when we integrate, it's two network businesses. You would have a global network, and you would also have domestic networks as well. And of course, you have to combine those units. In this process, we invest in new modern infrastructure so that we get the productivity up. It needs to be higher than we have today. And of course, as a result of this, in the transitional phase, there will be a requirement to lay off staff. But then once we've plateaued and we've set the new organization, we can then continue growing.
How long do you think that will take? Are we talking, 12 months or several years?
An integration like this, the majority of the work will be done within 2-3 years. Then it's only the things where you really require, significant physical infrastructure to be constructed. Apart from that, it will take 2 to 3 years to complete the integration. This is sort of the normal time horizon. We will inform about how the organization is set up sooner, so that people, they know what can be expected. It's always the uncertainty in such a phase that is very difficult, and we want to do our best, like we've done on other transactions as well, to shorten that time period so that people have certainty what is going to happen to my role.
Is DSV then open for acquisitions after this?
Yeah, it's been part of our journey. It's a capability we have. It's very often difficult for companies to do this with success. Actually, we have managed to do this several times before, and with a very high degree of success. So when you have that competence, I think it's also an obligation to use it. The company is right now the market leader. Once the transaction has been approved, we have 6 to 7% global market share. So it's in a highly fragmented market, and it is like other markets. Then you have when you consolidate, you simply have a better offering, and then you also have the economies of scale, so you become more efficient. And these sort of this will create productivity, and this productivity is, as you know, wealth that can be distributed both to our shareholders, to our employees, but it will certainly also benefit the industries we serve. Our customers, they really rely on a supply chain that functions. I guess after COVID, everybody's aware of this, and this will surely be strengthening the capabilities that are available.
Mr. Lund, are you concerned at all that DB's supervisory board could still veto the deal, or any concerns in the integration in these early stages?
Yeah, I think, there's always a risk, but I see both the the board of Deutsche Bahn and also the government in Germany. They're very competent and professional, just like we are. So when we are at this stage of the transaction, we expect that everybody will live up to the agreements we've made. And there's always then this specific thing when you have many stakeholders, and there's a little bit, what can I say, different focus from some of the stakeholders looking after their constituents. But after all, we consider our counterparty to be very professional.
Thank you so much for your time today. It was a real pleasure to interview you and hopefully get to know you a little bit better as this deal goes through. Jens Lund, the chief executive of DSV. Now, coming up, we're interviewed with renowned economist, businesswoman, and author Dambisa Moyo. We'll talk about the economy. We'll talk about what it's like being on boards. That's next, and this is Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Welcome back, everyone. Now, the Federal Reserve is poised to cut rates for the first time in more than 4 years next week as inflation continues to cool and the labor market slows. Now, investors remain divided on the side, with former New York Fed Reserve Bank President William Dudley arguing that there's still scope for a half-point adjustment. Now, this comes after the ECB reduced its deposit rate by 25 basis points yesterday, the second such move this year. Now, to dissect all of is how boards work and how they can work better in a chaotic world. Dambisa, thank you so much for joining us. You understand central banks. You're in the House of Lords. You speak to politicians. There's a little bit of a dichotomy about what the Fed says and does and actually what markets believe. And then there's a third wheel, which is what businesses are doing. Like, what are we misunderstanding in the U.S.?
Well, I think fundamentally there's still a lot of uncertainty that's exogenous to what the Fed is looking at. I mean, obviously they have their data and they understand the exogenous risks. But I mean, just to be absolutely clear, I err on the side of go for 25 basis points. Why get aggressive? And I understand very compelling arguments that it should have been, a cut should have come in July. But that notwithstanding, there's so much geopolitical risk. There's local risk in the United States with the election. There's deglobalization issues that are continuing, and we've seen escalation inflation in both of the big wars that are happening right now. It just seems to me, plus on top of that, by the way, the consumer is weaker, especially at the lower levels of income. And there are concerns about inflation still ticking up and core inflation in services. So why not just go for 25 and wait and see? It just seems to me to be the obvious thing.
But Dempsey, at the same time, there's this like elusive soft landing, which we don't 100% knows what it means. It's like it's something not ugly happening, I guess, in the economy.
Yeah.
Can we be so sure of that? And if you go 25 basis points, does it really make a difference to the trajectory of the economy if it's 25 or 50 at the next meeting?
Well, I think 50 to me feels more aggressive. You're absolutely right. There have been a number of announcements in the last several weeks of layoffs, even at 4.2% unemployment. The mood music seems to be cooling down. And you can see that in discretionary spending, as also with non-discretionary spending in particular. So I'm not at all saying that there isn't a slowdown coming. The inversion of the curve, 210s inverted. I mean, I think those are all signs that there could be a recession. It's certainly a slowdown. But to my mind, as decision makers, and whether you're allocating capital or you're making public policy decisions, you should really not be going more aggressive than need be. And I think it's not the end of the world. There will be more opportunities to cut more aggressively if need be. But there's just too many exogenous factors, it feels to me.
But again, so, there seems to be a feeling also that we shouldn't worry about inflation anymore. And I guess, as you point out, because of trade concerns, because of the U.S. election, we could really change the way that we trade, and also the dollar could possibly debase, although that's quite difficult to do technically. Yeah. But again, are we underestimating the risk of inflation coming back up?
I think we are. There's no doubt about it. I've been going to Jackson Hole for several years, and I think Jay Powell a couple of years ago was very patently clear about how long it takes to really purge the system from inflation. We've done incredibly well. They've done well. We are at a place now in Europe, in the UK, and in the US. We're close to those 2%. But that we should not be naive about what the sources of inflation are, and that those risks still exist. It seems to me that, if anything, and I've been talking a little bit about this for the last several months, that we could actually see more inflation in the financial markets. And there's that argument: PE multiples are higher, frothy markets, the whole Minsky argument. You get more stability, people start to borrow more. I mean, we have to balance these risks. So, sure, we're out of the sort of aggressive woods about inflationary pressure, but I wouldn't be so naive as to say, oh, it's completely stamped out and there's no risk. We have a war going on, and sure, even energy prices, looking at WTI and Brent, below $70, that's all comforting in some respects. And I know that there's I think Macquarie has a forecast of going to $50, but that could change at a dime.
Yeah, and actually, we don't know. I mean, how do you look at Trump policies, and how do you make a difference between what's being said at the moment and will actually be done if he becomes president, and what that means for fragmentation, globalization, and dollar debasing?
Yeah, and so I'm the vice chair of the Economic Club of New York, and last Thursday we hosted President Trump. It was an offer to both candidates, and President Trump took it up, and he came to the Economic Club for lunch. And it sounded to me, a lot of the tariff policies that he's been very explicit about in particular are net inflationary to consumers. I mean, I know he has his arguments as why that might not be the case, but I think fundamentally in the U.S., he's definitely pursuing or thinking about pursuing those more aggressive inflationary processes.
Is there any doubt in your mind that it'll be much more difficult if he's in power for the rest of the world economically?
So the fundamental problem is that we have a growth situation, weakness of growth around the world. And so, is it going to be much more a protectionist world? We're already in that world. In fact, Bloomberg argued that in 2009 was the peak trade protectionism. I think that where there might be new elements of protectionism are in the military and the national security spheres. And that's what people, I think, perhaps would say are new risks. I'm not a national security expert to speak more of that. But if you think about capital flows, immigration, these are big economic pillars of globalization. We've already seen sort of a decapitalization or the deglobalization in these areas. From a corporate board perspective, we've already been talking about this more siloed world. What does it mean for capital allocation? What does it mean for operations? What does it mean for procurement? And we've already started to make those type of adjustments. So I think it's an escalation of a sort of Trump world or more deglobalization.
Adamisa, thank you so much much. We'll come back. Actually, we'll talk a little bit, I guess, from the theory to the practical. What does it mean for boards and companies having to make difficult decisions shortly? Dambisa Moyo there stays with us. Also coming up, our interview with Wilbur Ross, former U.S. Secretary of Commerce, under Donald Trump's first administration. That's coming up shortly, and this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
And that's the other thing that was slow under Biden. They have a great deal of difficulty implementing acts once they've been passed. So in the case of this CHIPS Act, it was 2 years after Congress passed it and President Biden signed it. It was 2 years before they committed the first money. That left us exposed for another 2 years to the vulnerability of being an importer of 75% of all the semiconductors that we use. So I'm glad it finally got enacted. I'm glad it finally got appropriated, and I'm glad they finally implemented it. But that left us vulnerable for 2 more years than we need to be.
We talk a lot about the value of the dollar. Do you think it's too weak or too strong right now for the U.S. to really thrive economically?
Well, I think the U.S. is heading toward probably a very mild recessionary period. And that shouldn't be too surprising. It was artificially propped up by all the rate situations that had prevailed and all the cash that was pumped into the economy in the aftermath of COVID. I think they overdid that, and particularly they overdid it in the sense that that money didn't go into productive use. all of that money went into the hands of people who immediately spent it. So it increased demand by a lot, by trillions of dollars, but it didn't do anything to increase supply. So I believe that monetary phenomenon is really what caused the big inflation.
Well, that's Wilbur Ross, a former U.S. Secretary of Commerce under Donald Trump's first administration and a veteran of Wall Street, speaking to me ahead of the launch of his book, Risks and Returns, Creating Success in Business and Life. Well, welcome back to economist and author Dambisa Moyo. She's written also many books, so she knows what it's like to get a book out there and then try to analyze the world economy. Let's talk about what you do best, which is actually you sit on many boards and you translate all of these economics theory, geopolitics, and what it means for on the ground decision level when for boards. Are they thinking longer term enough?
It's a great question, and I would argue that because of the complexity of the world, because of deglobalization, because of a higher cost of capital, fundamentally the horizon has shifted shorter. I think it is the case that one of the mandates of a corporate board is to look further out into the future, think about taking long-term bets regionally, sectorally, in terms of technology, how do you operate, etc. But I think fundamentally, because of all the changes that I just outlined, we are seeing more complexity, and a more complex world makes it much more difficult to make bets. And so we are still focused in all the boards I'm involved with on capital discipline, thinking about how to allocate that marginal dollar in an effective way, thinking about operational excellence at a time of these massive juggernauts in energy transition as well as AI. But I mean, it is a very tricky thing to be making these bets, and when your horizon is shorter, and thinking about what that appropriate discount rate must be.
Dambisa, you're also a member, of course, of the House of Lords, so you understand the UK, UK PLC, UK businesses quite closely. What do they need from the new government come October 30th?
So we definitely needed a reset, and so political stability is always going to be a good thing. But I think we need to move quite quickly into a narrative coming from political leadership that this is a place to invest. Without investment, the country's going nowhere. And this is really important for growth. It's really important for some of the hopes that we have in terms of improving productivity through the adoption of technology and AI, which the Prime Minister was talking about yesterday with vis-a-vis the NHS. But it's also critically important to attract not just foreign direct investment, it's also attracting local investment. The key pillar investors like pension funds, insurance organizations, endowments, they're underinvested in this economy. The former Chancellor of the Exchequer, Jeremy Hunt, has talked about this. Others is very familiar that in 1992, about 30% of pension assets for UK pensions were invested in the UK. And today that number is around 1.6 to 1.9%. That's unacceptable. It's a bad signal to foreign investment, and this is not the time to be thinking about those negative things.
But so, Dambisa, if there's one thing that would make a huge difference, actually, in that budget, October 30th, again, is it some of the softer skills on how you portray it, or is there actually a financial incentive that should be in there?
Look, I think one of the classic examples, wherever you are, we know that there's going to be some changes to capital gains. It doesn't matter if you're a Democrat or Republican in the United States or indeed here in the UK. Everybody has pledged that there's going to be that change. I think the magnitude of the change will matter. I think also how it's spun. So we're going to have all these massive changes, but what does this actually mean for jumpstarting the economy? So the narrative is going to be very important, and what comes next.
Dambisa, as always, thank you so much for joining us. That was Dambisa Moyo joining us, and of course, we'll keep an eye on everything that's happening in the UK, and we'll have Dambisa back. Up next, Bloomberg Brief, Danny Berger, Manus Cranny in New York, and this is Bloomberg.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Graney alongside Danny Burgo. You're welcome to Bloomberg Brief. Let's set your agenda.
It's 50 versus 25. The great rate debate rages on after reports of the Fed's dilemma. No deal. Boeing factory workers walk off the job for the first time in 16 years, rejecting the deal on the table. The next step in AI, human reasoning. A new release from OpenAI pushes the capabilities to a new level. Good morning, Manus.
Danny, good morning. Let's test the boundaries of OpenAI a little bit later in the show. What we're testing this morning is the Journal, the FT, and of course, Mr. Dudley, all infusing an extra drop in the yield, down by 12 basis points from the high yesterday to this morning. This is on the short end of the curve. As you can see, yields lower again by 6 basis points. Why? Because suddenly 50 basis points is back in the narrative, back in the betting market. 33% possibility that you will get a 50 basis point cut next week. Is this just flying the kites on behalf of the Fed? To equity markets, again, it's as if we've shifted from buy the dip. We're incrementally moving towards FOMO. Oracle is up this morning, nice guidance for them next year and through to 2029. Significant move lower, as I said, in the yields. The consequence of that is the dollar is on the back foot. The yen is up for the fourth day, counting down to the BOJ next week. Danny, good morning.
Good morning, Manus. How serious is this chatter of moving 50 basis points? Nick Timiraos was the thing that moved yields from gaining on the day to losing, writing the Fed's rate cut dilemma. Start big or small, and then you get this from the FT. The Federal Reserve faces a close call on whether to cut by a larger or a quarter point percentage for a cut. It might be just because we have those memories of June 2022 in our minds, where Nick Timiraos put out a story that shifted the market's thinking from 50 to a 75 basis point hike, and that's indeed what we got, 75 basis points. Or is this just setting us up for a dovish 25 basis point? I mean, what really in this market, what we've heard from Fed speakers, there's been nothing there to suggest that they're ready to go at 50, maybe except for Powell himself.
Well, maybe this is the juxtaposition between what the market is pushing for and perhaps what the Fed wants to deliver.
Totally.
And perhaps it's trying to bring that narrative together at 25 basis points, but with a nice dovish tilt. Bill Dudley, of course, ex-New York Fed governor. I think there's a strong case for 50 basis points, and I know what I would be pushing for. So this is about the concertina between Powell and the rest of them, and trying to bring that closer together.
Well, you could see a scenario where you have this discussion after the FOMC decision and what you get in the dots, and it makes it clear that maybe even if they don't go 25, they want 50 at some point. Maybe they still match market expectations of 100 basis points, and maybe that's what's more important from what we get and why we're seeing some of this kite flying of a jumbo rate cut.
Well, it's certainly that. I mean, you've got all of that. Does it embolden somebody like Waller to join in with Powell? And you know what? There's a lovely line from Neil Dutta at Renaissance, which is, go in size when you've got the time and the scope and you've got the space to do it, rather than when you are forced to do it.
Yeah, a lot of people argue that. Maybe it's just, stasis from the Fed and what they usually do and the inability to break from that. Let's get over to Thanos Mamfakides, Global Head of G10 FX Strategy at Bank of America Global Research, who joins us now. Thanos, great to see you this morning. So is this really a live decision? Do you think it's likely the Fed doesn't know at this point whether they're going 25 or 50?
Based on the data and the fundamentals, they should go by 25. But the truth is that all the speakers have not really closed the door to 50. So at this point, is a close call. What I would say, if they go with 50, it will not be as if the Fed knows something we don't know. It will mostly be a preemptive jumbo cut to avoid a risk of a hard landing down the road. However, preemptive aggressive cuts could lead to a shallow easing cycle. So the big scheme of things is how far the Fed can go.
Thanos, good morning. Maybe next week, and we've got to see where we end up. What do you make of this proposition that this is the market pushing and pushing for, if they get 25 basis points, but to get a more explicit narrative on the destination? They didn't get it from Christine Lagarde, so maybe this is pushing to get clearer dovish guidance from Powell.
I mean, a lot will also depend on retail sales that we get before the Fed meeting. But no matter what the Fed does in terms of 25 or 50 bips next week, I think the guidance will be dovish. Powell will be able to do what Lagarde was not able to do yesterday, to announce a proper easing cycle, while Lagarde is just removing restrictiveness. That's a paradox in a way, because the US data is better than the Eurozone data, but the truth is that the US economy is in a soft landing, is slowing. The Eurozone economy, on the other hand, is stuck with sticky core inflation, and unemployment, at least, is increasing in the US, is not increasing in the Eurozone.
I mean, what do you make of that? The fact that there has been this dollar weakness, that's the bias for this market. And I understand what you're saying, Thanos, that you still have the stickiness of inflation in Europe, but it is a much stronger US than not just Europe, but economies like China, too.
The truth is that the US dollar is overvalued, and if we're in a world of a soft landing in the US with the Fed cutting rates, this is still positive for risk and negative for the dollar. We are in the middle of the dollar smile. Now, the dollar would weaken even more if we were to see faster growth in Europe and in China, which is the ideal scenario in the middle of the dollar smile. That's not what is happening. So it's driven primarily from the US soft landing and the dovish Fed, but this is still enough to lead to a gradual weakness of the dollar from a long position, which is exactly what we have been seeing.
So, Thanos, are you saying that the dollar's exceptionalism, US exceptionalism, is now really challenged?
Up to an extent, yes. We can argue that the US exceptionalism was also driven by very loose fiscal policy. The US economy will continue performing better than the Eurozone economy, but is slowing. This is a big deal, and the dollar is overvalued, so there is room for the dollar to weaken. Our forecast for euro dollar by the end of the year is 112, which is not very aggressive, actually. We're at 111 right now.
So I take it you disagree with Morgan Stanley then, Thanos, who says that there is a risk of near parity, about 102 euro versus dollar. What do you make of that call? It's predicated on the fact that the market's underestimating just how much the ECB may cut.
We completely disagree with this call. Our view is that the ECB will be cautious. The Fed is starting most aggressively. In both, inflation is sticky, but the US is slowing, and the euro-dollar long-term equilibrium is 120. in the past, you went close to parity only when there was a severe shock. And that's not what we have today.
So you're taking some quite contrarian positions here. So let's extend that with Darren Maher from HSBC with us yesterday going, I don't understand why it's at 110 at the moment. 10 weeks of soft data. Germany's under pressure. Perhaps they should be talking more about jumbo cuts in Europe than in the US.
The mandate is different. The truth is that core inflation in the Eurozone is stuck at 2.9, 2.8%. Services inflation has increased. Unemployment is not falling. And actually, Eurozone growth is not really slowing compared to last year. Germany is weakening, but the rest of the Eurozone has stabilized at a low growth equilibrium. So in relative terms, it is hard to justify a weaker euro at this point, despite the weaker data. Weak data in the Eurozone is not new news. It has been happening actually since the global financial crisis and has to do with structural reasons.
While we're talking about contrarian position, Thanos, you are bearish on the yen. The yen, though, at this moment, dollar yen at 140, but its lowest since July of 2023. Why would you push back on that?
Well, up to an extent, we can argue that yen has moved quite a lot, and if the Fed cuts by less than market pricing, you can see some renewed yen strength. Having said that, I think we have shifted to a regime in which if we do get a new dollar-yen rally, we will sell it. And in any case, we don't expect dollar-yen to weaken by much because we don't expect the Fed to go that far cutting, and also we have structural outflows from Japan. So it's not that we are bullish dollar-yen, we are just not as bearish as the consensus.
Okay, well, that yen has moved by 14%, strengthened by 14% since the end of June. Great conversation, Thanos, as this market revs up again on the risk of a 50 basis point cut from the Fed. Thanos Vampakidis of Bank of America Research. There are other stories trending on your Bloomberg terminal this Friday. This is what we've got for you. Hedge fund Millennium Management is looking to raise between $7 to $10 billion of new capital. It will do so by asking the clients to make pledges that Millennium can tap over time. Like its peers, the hedge fund has been moving to lock up its client cash for longer.
Berkshire Hathaway's vice chair of insurance operations, Ajit Jain, sold $139 million worth of his Class A shares in Warren Buffett's conglomerate. The sale of 200 of his Class A shares marks a shift for him after adding to his holdings in the year up to March. He is one of Buffett's top lieutenants.
Hindenburg Research is taking another swing at the Adani Group. The short seller has said in a post on X that the Swiss authorities had frozen more than $310 million. This was part of a years-long probe into the Indian conglomerate for money laundering. The Adani Group denied and called it baseless allegations.
Coming up, Boeing's largest union says to a labor deal. They say no, setting up for a strike for the first time in 16 years.
And later this hour, we speak to BlackRock's Amanda Lynham on why she believes the drivers and depth of the rate cuts are more important than the timing. Context matters on Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
We just announced over in the Stewards Hall that our members rejected the contract by 94.6%, and they voted to strike by 96%. There's a lot at stake here for our members, and so I am proud of them. And we're going to, get back to the table as quickly as we can. I'm not sure what that looks like this evening, but we'll certainly engage so that we can try to resolve the issues and address what the members' needs are.
John Holden, the president of Boeing's largest union, and the workers have walked off the job for the first time in 16 years. This is after rejecting a labor deal. This strike involves 33,000 workers. It further cripples this plane maker's manufacturing process, the Seattle commercial jet hub. Guy Johnson is no stranger to the airline story. The stock's down 3.85%, 33 workers going out. And if they go out for their typical time, how wide is this gap between management and the workers' guy?
Manus, Stephanie Pope, who runs the commercial operations at Boeing, says that they've left nothing on the table, but clearly they are going to have to find something and put it on the table because Boeing can ill afford this to go on for very long. 2008 was the last strike. That lasted circa 50 days. The longest one was back in 1948, and that lasted 140 days. There's some talk, Manus, that this could go to federal mediation. That would probably mean this process is a long one. There's some talk that this could last until Thanksgiving, and if it lasts until Thanksgiving, it could last into the new year. So Boeing is going to have to find some more money. This appears to be about money. The 25% that has been offered appears not to be enough. For the vast majority of workers, the removal of the bonus has gone down very, very badly. Boeing, with its new CEO, is going to want to get back around the table. How much more money can Boeing find is the key question.
And Kelly Ortberg, the new CEO, had just said before this, essentially, don't go on strike. We're in a vulnerable time. What will be the impact, Guy, to Boeing's operations if this continues to drag on?
Boeing gets paid, Danny, when it delivers aeroplanes. It will not be able to deliver aeroplanes. As you say, it's got a multitude of other challenges that it is facing right now. It needs to deal with those. It's had massive problems with the 737 program, the MAX program. It's having big problems with the 87 program. It's got problems with the 777 program. It needs to get back on track. This comes at a very, very bad time. I guess that probably is why machinists view the power they maybe have and are making this decision. But they're going to want to get this done very, very quickly. Boeing gets paid when it delivers airplanes. This is going to make that very, very hard. It's going to have a meaningful impact on cash flow, and that is why the stock is down this morning. The expectation at the beginning of the week that this deal was going to go through. The deal had been done with the union. It's been clearer over the last few days that the bulk of the machinists were going to vote against it. The market's been getting ready for it, but the fact that this has now happened is being reflected in the share price that is once again softening this morning.
Yeah, the strong hand in the machinist. Guy, thank you so much. That's Bloomberg Opening Trade co-anchor Guy Johnson. Let's move on to tech now. OpenAI is releasing a new model capable of performing some human-like reasoning tasks. It's known internally as Strawberry. The company says the tool will be able to solve multi-step problems, including complicated math and coding questions. Joining us now on this story is Bloomberg's Tom McKenzie. Tom, just how big of a step forward is this?
Well, OpenAI say this is a major evolution in terms of the process and the development and the innovations around artificial intelligence. And there are experts out there who say there are also potentially some benefits in terms of the safety and reducing risks around some of these technologies. But this is early stages in terms of where we are. This is not about generating answers by scouring the web and data that's been fed into these models. This is about reasoning, as you said, and it can be a multi-stage process. These models are trained using reinforcement learning, so they're essentially rewarded when they make positive moves and they get these steps correct, they are given a reward, and that's how you build these models. And so they're very effective, it seems, in terms of the first iterations, and we're just getting our hands on them, in fact, as of yesterday, to do things like coding and very, very complicated maths questions. These are not multimodal models, so they can't deal in audio or visual, like, for example, ChatGPT-4 can. But this is a major step, OpenAI says, in terms of this reasoning capability. Anthropic, Google, also working along models along these lines. So we should see further progress you would expect in the weeks and months ahead. And of course, it's pretty important it comes out of a week when OpenAI, on some measures, was valued at about 150 billion US dollars.
Yeah, well, just think of the additional power that is going to be needed here. A ChatGPT inquiry takes 10 times your average search. So if you just think for AI reasoning, just multiply that up. Look, Oracle's had a pretty blistering week. All-time high at the start of the week. That was on some of their web businesses. But again, they've given really, really strong guidance about next year and a little bit further out. It's very solid and assured guidance, isn't it?
It is, and look, you're absolutely right to tie it to the fortunes of OpenAI to some extent as well, because it's the cloud database software that Oracle produces that has proven very effective at dealing with these heavy generative AI workloads, and that's what their customers are happy about, and that's why you can continue to get these sales coming through for Oracle. And you're also right, look, this is a company that's been nodding at this kind of performance and nodding at these results, nodding at this demand. There was an expectation from analysts that they would upgrade their 2026 fiscal year forecast. What wasn't expected is that you'd also get that guidance pushed out on the upside for 2029. So they now see revenues rising to at least 104 billion US dollars in fiscal 2029. They upgraded again the 2026 targets to 66 billion US dollars. Look, some of their customers include xAI, Elon Musk's xAI, Reka as well. The analysts coming out and saying, look, the clear response is, the details are in terms of the upgrade for 2029, it really suggests that Oracle sees these tailwinds around Gen AI continuing in the years ahead for their software.
Yeah, well, certainly OpenAI back in that market. It's timely on their piece as well in terms of what they can do. Helps you on that roadshow to raise money. Tom, thank you very much. Bloomberg Daybreak Europe anchor Tom McKenzie. Coming up in the show with Danny and myself, we'll take a look through the headlines that are making news around the world, including a report that Trump allies want to privatize Fannie and Freddie. Context matters on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Wednesday, the Fed decides.
I know we're all obsessed about what the Fed may or may not do on September 18th.
25-50, that doesn't matter so much.
We're being very measured where maybe other central banks aren't.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We have made no decisions about future meetings, and that includes the September meeting.
At this point, the Fed is leaving it open.
It's going to be up to Chairman Powell.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
It's your Bloomberg Brief. On this Friday, I'm Danny Berger alongside Manish Cranny in New York. Let's get you some front page news. What's making headlines around the world? First up on the Bloomberg, Danish freight firm DSV is buying its German rival for 14.3 billion euros. They beat the PE firm CVC Capital in a race to acquire the company. The deal makes DSV one of the world's largest logistic companies.
Next up, the FT. Pink Floyd are in talks with Sony over the music rights sale. Now, the talks have been advancing after personal differences among members of the band. Strange that, in rock and roll. But reaching an agreement, a little bit more difficult. Can you imagine that? Catalogue valued at $500 million. Rockers on the road deciding how much their music is worth.
That's a hot asset. Everyone wants to buy music rights. Okay, so this from the Journal this morning, Manis. Trump allies are working on a plan to privatize Fannie and Freddie Mae. Discussions have been underway since at least spring. One thing is clear is there's some people who stand to gain from this. Both Bill Ackman and John Paulson are holders in Fannie and Freddie Mae. They both support Trump, and they both have been calling for privatization of them.
Yeah, look, this goes back a long way. Of course, Fannie and Freddie don't issue mortgages. Everybody knows that. But it's the 2019, it was the Trump administration. They floated the idea about releasing the grip. And guess who's in charge then?
Well, okay,
Treasury Secretary Steve Mnuchin. So,
yes.
You know, he's got a bit of form in these things.
They gave up on it essentially because when Trump lost the election, and then two, COVID was happening, and there was this sense that the housing market was so fragile that messing with these behemoths would be an issue. I mean, you could make the same argument at this moment, Manis, that housing is quite particularly in a vulnerable spot as we start to debate rate cuts, considering the unaffordability of housing. Is it an issue if you start to tinker with these? But there's always a difference between what kites are floated during a campaign and what actually is a policy that the administration wants to pursue.
Well, I can tell you, as the dominoes fell over that period of time, you know, between Lehman, Fannie, and Freddie, and a host of other institutions, it's the kind of systemic part that it is in this housing market in the United States of America. There's only one story that's rocking and rolling. It's 50 basis points. We're back on the cards again. Have a look at the 2-year notes over 4 days, and you begin to understand. Risk on, risk off. 25, 50. There you go. What have we got? Down 12 basis points from yesterday?
Yeah, you pointed this out to me, how big of a swing, down 12 basis points from the high of yesterday. I think we can have a robust debate coming up on just how much that journal story actually matters. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manish Cranny. Let's set your agenda.
It's 50 versus 25. The great debate rages on after reports of the Fed's dilemma. No deal. Boeing factory workers walk off the job for the first time in 16 years, rejecting the deal on the table. The next step in AI, human reasoning. A new release from OpenAI pushes the capabilities to new levels. Danny, good morning. Can't wait for that.
Can't wait for that. Maybe you won't see me standing in front of here doing a market check. Maybe it'll just be OpenAI reasoning in a human level to do this. Anyway, Manis, the thing that we need to reason around right now is a story from both the Journal and the FT saying that the Fed is trying to decide between 25 or 50. That was enough to both reinvigorate the equity market. Equity during the cash trade moved higher. S&P futures higher yet again by 0.2%. It also reversed what we were seeing in yields. Two-year yields go back to around their lows in 2 years after moving higher yesterday. That swing from yesterday's high to today's low, about 12 basis points, 3.5%. And the dollar versus the yen, that weakens by nearly 1%. We are at 140, the weakest level since summer of 2023. And Menace, all of this, again, appears to be off the back of a story from Nick Timiraos, basically titled The Fed's Dilemma, Go Big or Go Small.
Yeah, I mean, I've had some pretty scathing IBs in terms of this particular article. And I think what it does do, if anything, it brings back for the Fed the optionality, which had been taken off the table. If you look at the two-year notes over the past 5 days, that optionality had been taken over the table. You and I sat down with HSBC. We sat down with Allianz. HSBC said, get this snowplow out of the way. They don't need to do 25 basis points is what Allianz said. But maybe the Fed will welcome this optionality, the fact that 33% possibility of a 50 basis point cut. It means it can be not such a shock if it comes down the pike. But it's still the skew is, it's unlikely.
Right, well, it just feels like the first Fed decision in a while, and these stories really enforce this, that we just kind of don't know what they're going to do. Maybe it just allows them to have more FOMC members to say we wanted 50 basis points and set themselves up to go at it later. It's a really confusing one. I was kind of joking in the break. What if Nick Timiraos was simply trying to write just like a big thought piece, and now we're left just trying to read the tea leaves of something that maybe isn't exactly there?
But I think that just shows you how febrile the whole situation has become. You've got Powell, we know a little bit more, Dovish at Jackson Hole, we've got Waller open to doing bigger cuts. This just shows you just how fine a line we are on. Amanda Lynham is our guest this morning. She's the head of macro credit over at BlackRock. Now, you're going to have a much smarter answer than the both of us. But this whole narrative that the kite is flying again on 50 basis points, our guests have said, tuck it away. What do you think of the Journal article? What do you think of the risk of 50 basis points, the risk and necessity?
Yes, well, good morning. Thank you for having me. I don't think we can rule out a 50 basis point cut. I think the important thing that we've emphasized, though, is that the depth and the drivers of this rate cutting cycle really matter for corporate credit sentiment and I think risk assets more broadly. If there is a start to the cycle that begins with a 50 basis point rate cut, I think the messaging needs to be very crisp around where the neutral rate is, why we are starting with a non-traditional magnitude of cuts, because absent that sort of clear messaging that we are doing this to get back to a neutral territory, I think the market could interpret that to mean that they are responding to some sort of growth downside. So I think the messaging around the drivers is really important. And then more broadly, leaving kind of this year's rate cuts aside, we believe that there's scope for the Fed to cut to the, say, call it 3.25%, 3.5% range next year, and then we need to start having more clear conversations around where is neutral, where is the destination. It's not to say that they couldn't cut beyond that level, but I think once we start to get in that zip code, I think it becomes a more finely balanced decision as to are we normalizing or are we actually easing?
Well, because the oddity of it, of cutting something more than 200 basis points within the span of a year is usually something you'd see in a recession. Yes. But as you're talking about, it could just be getting us back down to neutral. Do you trust in the Fed's ability to communicate that if that's actually what they want to do?
I think they will have to. They've been communicating to us that the neutral rate is moving higher by function of the longer run Fed funds rate. So it went from 2.5 to 2.6, 2.8. We'll be watching the SEP in the September meeting to see if it moves further from that. Fed officials have also said that short-term neutral could even be above that 2.8% long run dot. So I think the directional trend they've been messaging, but for corporate credit, what that really means is that we are unlikely to revisit the depths of the zero lower bound of rates that prevailed for much of the past 15 years, and I think we need to adapt to that.
Can we just talk about the structure and the flow into credit? Yasser Mohammed Al-Arian was with the team and he said, look, money from the sidelines is coming into bonds. It's like the last sale of a decent yield in bonds. What are you seeing in terms of that flow into credit?
In addition to the money from the sidelines that's coming out, and I would say even asset class rotations, keep in mind that we are in a higher coupon environment, and all day, every day, bonds are throwing off higher coupons that need to be reinvested in the market. So the technical picture is really strong, not just from the demand side, which you mentioned, Manus, but there hasn't been a lot of new supply that isn't related to refinancing risk, specifically in the high yield and leveraged loan markets. And so we have a very favorable technical setup in corporate credit. It's a very growth sensitive asset class, though, as you know. So there is a lot of scope for spreads to widen if we have a severe growth downturn, not even a recessionary downturn, but just a really sharp slowing, not our base case. But actually, it's been hard for the credit markets to sell off in a sustained way. You've seen the markets try to widen. Money comes in, especially yield-based demand. So there is this tug of war between, I would say, tight spreads, as we've discussed before, but actually still pretty attractive all-in yields, and we think it's a pretty compelling opportunity.
Well, to the point of higher coupons, this is from JP Morgan. The high-grade issuers are going to pay $420 billion in coupons this year. That's up almost 20% from last year. And this idea that even if rate cuts are coming, higher costs stick around for some time because there's a lag there. So what does it mean for these corporates to have an environment where bond expenses aren't falling as fast as potentially margins are?
It's right. I'm less concerned about the investment grade cohort of the universe because they just have so much financial flexibility and a cushion. But your point is well taken, is that we had ultra low rate environment in 2020, 2021. A lot of debt was put on the books. That's rolling off. It's getting refinanced at a higher cost. I will tell you, though, corporates have shown an ability to navigate that. Actually, EBITDA and earnings, for the most part, have held up pretty well in a higher cost of capital environment. We've already seen some damage as well in the default rate. So I would say that actually the weakest among the corporate credit investors have been responding to this higher cost of capital. Leveraged loan defaults have outpaced high yield bond defaults by the most since the Moody's data began in 1995. And so we're seeing it come through.
We started the year talking about the risk of a 2025 refinancing wall.
Yes.
From the action that you've seen, has that been much reduced? And that's much less of a risk and therefore contains the credit spreads into 2025, even looking at a slow slowdown.
That's right. The catalyst for spread widening is unlikely to be a payment shock in our view, right? It's more likely to be a growth downturn. Corporates have been so proactive, Manus, that they are now chipping away at 2026 and 2027 maturities, right? So high yield corporates typically don't let their bonds become current or due within 12 months. So we should always be expecting that very near-term maturity walls are low. That's just prudent risk management, but it's gone even beyond that. They've extended way beyond that 12 months, and they're actually refinancing a few years in advance. I think that's prudent, given some of the headline risk later this year, potential for a growth slowdown, although not our base case. Always good to refinance when you can, not when you have to. And I think the volatility from early August showed us that things can change very quickly.
Right. But as we've been talking about, a lot of the action in the corporate bond market has been refinancing. There's been less so about deal activity and funding deal activity. As we start this cutting cycle and we kind of reflect back on where we've been, is there any element where, because companies have been unable to make those kinds of actions, that they've been able to do less things that allow for expenses maybe to come in, more efficiencies, that the just trajectory of growth is going to be slower?
Yeah, so for sure on the sponsor-related M&A side, volumes have been pretty muted still. So those are deals that are involving some sort of private equity or leverage transaction. Strategic M&A, however, is actually running well above the pace of the past 2 years, and it's not that far below the 10-year average. I think part of that is that the COVID pandemic shined a light in a lot of CEOs and boardrooms' minds that there are gaps in business models that need to be filled through inorganic activity, so diversifying your business through acquisition. The swift rate hiking environment put a pause on that. Now that we have more clarity on the environment, optimism around avoiding a recession, CEO confidence, actually that activity has started to come back across a range of sectors. It's not obvious to me that corporates are really hunkering down and preventing themselves from moving forward with the strategic actions that they need to take. I actually think if we can actually get the rates cut cycle going a bit, get some clarity on neutral, I think it would be a really strong tailwind.
One thing that came through from Allianz yesterday was that everything sort of comes to this kind of crunch stop over this election. Either the Fed is crunched into a stop, or the world crunches into a little bit of a crisis in terms of a challenged election. What are the reverberations? What are you seeing in terms of preparation for that, if at all, or the consequence of a challenge around the election?
It's really all about the policies from our perspective. I think having prudent diversification and nimbleness in portfolios is really what it's going to come down to. I think it's very difficult to call in advance because there are so many different paths that policy could take. But really what we're watching are what does this mean for trade, for tariffs, taxes? Those are really the key impacts for corporate credit investors.
Amanda, always brilliant. We really love having you on. Thanks for joining us. Amanda Lynham of BlackRock. Enjoy the rest of your Friday and your weekend. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We just announced over in the Stewards Hall that our members rejected the contract by 94.6%, and they voted to strike by 96%. There's a lot at stake here for our members, and so I am proud of them. And we're going to, get back to the table as quickly as we can. I'm not sure what that looks like this evening, but we'll certainly engage so that we can try to resolve the issues and address what the members' needs are.
That was John Holden, president of Boeing's largest union. Boeing workers are going on strike. It is the first time they've walked off the job in 16 years. It involves 33,000 workers, and it further cripples production at the Seattle Commercial Jet Hub. Joining us now in person is Benedict Campbell. Benny, great to see you. I know you've just been out and about in D.C. talking to a lot of the industry. What is the wider implication of having a strike at a time where Boeing is trying to get back off the ground, and they are trying to fix a lot of problems?
Well, you said it. Really, this is a company in trouble already, and this is the last thing they needed is one more thing they need to work with. And we heard here from Holden saying, let's see how we can get out of this. He said himself, I don't quite know how it'll go. But if you listen to his words, he seems to sort of extend an olive branch and say, we think we can get this resolved. It's unclear what exactly the metrics will be. Will it be pay? Will it be more on pension or on bonuses? They did get the guarantee that the next aircraft would be produced in the U.S. or in the Seattle area. So that's good for workers. But really, they felt shortchanged on this one. So it's really going to be about the money, which Boeing doesn't have.
Look, you say the workers felt stiff. There's gaps here. There's gaps between the workers, the union leaders, and management. If I look at what Stephanie Pope had to say, she said, we put our best foot forward. So where are they going to get the extra money to close these gaps? Because they're already under a lot of pressure.
That part is unclear because, Boeing really doesn't have the money right now. They're bleeding more than $1 billion each month, and that's not going to get any better. The production is going to be disrupted, and that will in turn cause more financial strain on them. There are estimates out there that a prolonged strike might cost as much as $3 billion in cash flow. And this is a company that has a credit rating that's close to junk, and that's something that investors are watching very, very carefully. They have $45 billion in debt, so they need to protect that credit rating. So very little wiggle room for them, but ultimately putting a little bit more money into the pot is better for them than a protracted strike. So that's really sort of the balance they need to strike.
And what a way for Ortberg to start the run as CEO. In what way will this reflect him, Kelly Ortberg, as CEO, and how he moves forward in managing this company?
You're absolutely right. I mean, he's really been thrown into the deep end here. He put out a message a couple of days ago saying he urges everyone to leave the past fights behind, move forward, see the light, as it were. But there was sort of a bit of a veiled threat in that message, and that's at least the way it was read by workers. It's like, if you do this, there's nothing good to come out of the strike, and maybe that will have sort of energized people. You saw the numbers, more than 90% on both counts. He's stayed a little bit in the background for now, so what this might give him is a way to come forward and really take the helm of the negotiations. Those have been led by Stephanie Pope, as you said, Manus. So Ortberg can come into this now, and if he can turn it around, then maybe if it's a short strike, he'll be seen as somebody who made peace with workers, and that'll go a long way.
Well, that carries a lot of favor in many of these organizations. You're on the road. This kind of disruption, additional disruption at Boeing, I'm not saying it's necessarily an opportunity for Airbus, but it certainly must bolster the narrative for them relative to Boeing, again.
Yeah, again, exactly. And this is something we've seen since the start of the year, and probably even before then. You know, Boeing's been in several years of crisis.
Yes.
Airbus has said, look, we take no pleasure in our rivals' misfortunes. Something going wrong at one manufacturer is bad for everyone, particularly something that's safety-related. And the truth is, Airbus have issues of their own. They're not as pronounced as Boeing's, but they can't just sort of jump in and say, anyone want to buy a couple more planes? Because they can't produce them at that speed. This is a very long-term industry. Contracts are long-term. Relationships are long-term. So you don't just sort of switch from one manufacturer to the other. But the optics are that, you know, this is one company that's down, one that's up. You're slowly seeing a diverging path in terms of the market share. It used to be pretty much 50-50 on the narrow-body aircraft. Now it's more 60-40, probably moving more towards 70-30. So that's all happening.
Well, this all comes down to the reliability of the partner that you have in the supply chain that they're dependent on. Benny, thank you. Good to have you here in New York. Safe trip back to Germany. Benedict Kamel there on the very latest from Boeing. OpenAI, they are releasing a new AI capable of performing some human-like reasoning tasks known internally as Strawberry. The company says the tool will be able to solve multi-step problems, including complicated math and coding questions. Two of my favorite subjects in the whole world. Tom, you're right, Tom McKenzie is with us. So Strawberry is the name of the game. I was, you know, math and coding, well, coding wasn't around when I was a lad. So Tom, talk us through the next iteration of OpenAI.
Yeah, Manus, I was just imagining this is your weekend set up, isn't it? The coding and the maths problems. And now you'll have a hand in that effort, in those weekend joys, Manus Cranny. Yes, so they've come out with this new model that is focused. They say, look, this is going to provide a new AI capability. Their competitors, Anthropic and Google, have been working on this as well. They have similar capabilities that are coming to market. But it is seen, at least by the team at OpenAI, as a pivotal moment in terms of the ability of this technology to perform tasks that even GPT-4, their most sophisticated and largest model, still cannot perform. So that is crunching and coming up with answers for some of those most complicated questions and riddles, whether it's science questions, maths questions, or indeed, and some of the demos have showed this, actually doing coding and building things like games in a matter of minutes. Here's the challenge, though, around this new platform, this new model that they pushed out. Number one, latency. Basically, it takes a long time for them to answer, the model to answer, because what it's doing is working through different scenarios to reach that answer. It is reasoning to some extent. It's been trained to do this through reinforcement learning. So it takes a bit of time to come to the answer. It's also not multimodal, which means it can't deal with things like audio inputs and visual inputs. But they say, they're working on this. That's a longer-term goal. They're also, by the way, working on GPT-5, so the next iteration. Both of those things in parallel and complementary is what the OpenAI team say on a week when, of course, they're looking to raise $6.5 billion raised and valued at around $150 billion. Maybe this will give investors more pause for thought around that question, or at least give them more of a catalyst to potentially fund this business.
Yeah, I gotta be honest. I'm imagining Manus like with a roaring kitty set up, like a gamer chair, screens everywhere, tie around the head. In the meantime, Tom.
Roaring kitty. Oh no.
That's literally what Manus looks like on the weekend. Okay, anyway, Tom, we'll save him. We'll move on. Oracle up pretty decisively pre-market, some 6%. A very optimistic forecast. What was behind that?
They've been hinting at this. Analysts have been waiting. They had expected an upgrade to the fiscal 2026 forecast from Oracle, but what they weren't necessarily expecting was an upgrade to the 2029 fiscal forecast. $104 billion in revenues for that period is what is now being forecast by a company that has really benefited from their cloud software, their database software that really aligns with generative AI and the workloads, the heavy lift, basically, that workload requires. Their software has performed well on that front, and they're seeing that demand from their customers, who include, by the way, Elon Musk's xAI. That's a company they tout. So they upgraded the forecast for 2026 as well, $66 billion, upgraded for 2029, $104 billion. Analysts saying that this shows that at least for this company, Oracle, those generative AI tailwinds are still there. Year to date, the stock is up around 53%, but as you say, pre-market looking higher again.
Tom, thank you so much. Bloomberg Daybreak anchor Tom McKenzie. As I'm spying on Manus's computer with a picture of Keith Gill. You getting your outfit ready for the weekend?
I don't know whether I want a red headband, you know, I mean, is this is your perception of me over the weekend?
Yeah, the gamer chair, all of that, just like hunkered in, screens everywhere, coding away.
I mean, this she's putting out falsehoods. There you go. That's Manus in the bottom left. So this is me. Actually, I have friends that are meme traders, and they follow everything with this guy. No, I'm not wearing the red hair. No, I just like barely have any hair to talk about, so I don't think we need to worry about the long tresses, the locks there. No, that's definitely not me. GameStop Corporation. There you go.
Okay, well, that's Manus's weekend plan, but before that, we're going to set you up for the whole
live
week.
on Instagram for you with my headband.
Tune in to Manus's Instagram Weekend This Live. He'll take you through his latest coding project.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Get you set up for your trading day on this Friday. Coming up, we're going to have the University of Michigan consumer sentiment data that comes out at September at 10 a.m. Then former President Trump will have a press conference that occurs at noon. President Biden then hosts UK Prime Minister Keir Starmer at the White House. On the agenda, Ukraine, Gaza, and the Red Sea. Manus, what do you got for our stocks this morning?
Danny, top end and the bottom end of this market are moving. You got Mag 7 on the up, and it's tech in focus. Boeing is the drag here. We know that we're actively in this strike. What is it that management have got to put on the table to bring them over the line? 25% pay rise was put down. You've got Adobe down 8%. 0.28%. Again, delivering an outlook that failed to quell investor impatience, especially around the AI tools. And then Oracle, as I say, very, very strong innings for them. Annual revenue will rise to $104 billion. That's by 2029. And an optimistic view on the growth prospects, of course, in, you got it, the cloud business.
And meanwhile, Manus, it is a market that's in rally mode for equities. Meanwhile, bond yields fall by 6 basis points, just nearly on the front end, as that debate of 50 versus 25 comes alive yet again.
Yes, dreams and hopes live eternal. It's been called Nikki Leaks, of course. It's the Journal story. But don't forget, Bill Dudley said he'd be calling for 50 as well. Surveillance is up next.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community,
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The market overall is a little bit vulnerable.
I think there is significant downside risk here, recession or no recession.
Recessions come from policy errors.
Markets are underweighting the impact of those pro-growth policies in the beginning of the year.
Definitely balanced risks looking forward into the next multiple years.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500 on a 3-day winning streak. Make it 4 in yesterday's session, and looking to make it day 5 this morning. Equities up by 0.2% on the S&P. On the NASDAQ 100, just about positive. Last week on the S&P, the worst week of the year. This week on the Nasdaq, the best week of the year so far. That's the equity picture. Switch up the board and get to the bond market and look at the signal at the front end of the curve. The 2-year yield down by 6 basis points, 357.83. We have a live meeting next week, and it is very finely balanced between 25 and 50. And all it takes, Bramo, is a few comments from some former Fed officials, and now the weight starts to shift back towards 50.
Normally, a lot of articles and commentary reflects a shift in markets. The markets had clearly shifted to 25 basis points. To hear Bill Dudley come out, and who actually has supported 25 basis points before at a meeting, come out and talk about how there is this important argument now toward potentially cutting by this amount. Just to give you a sense, I think there's a strong case for 50. I know what I'd be pushing for. At the same time you get a Wall Street Journal and FT article, suddenly it's about 50-50 whether they go 50 basis points, which would be the most undecided meeting in years.
What stands out for me is when Dudley said it's basically up to Chairman Powell to see how much support he has for being more aggressive. So if he's able to get to that consensus, based on you were at Jackson Hole, what he said, talking about how he's concerned about the labor market, could potentially he go for the 50? And then also at the same time, you have these outliers at Citi. Andrew Hollenhorst was pushing for that 50. He saw that inflation data and said, actually, it's going to be 25.
So let's run with the totality of the data. CPI came in a little bit hotter than expected on core. PPI came in a little bit hotter than expected. Then we saw jobless claims still subdued. 4-week moving average around 230,000, and yet here we are having a conversation about 50 all over again.
I think that you should keep using totality of data because that's nice and meaningless. That's sort of what we're learning increasingly, and I'm not blaming that on you, but basically that's what we're finding out.
I'm not taking it personally.
I mean, I think that there is this question about the totality of what data? The upcoming data that you haven't seen yet, is this an insurance cut, which is essentially what we have heard from Nick Timiraos and Colby Smith at the Wall Street Journal and FT, because that seems to be the big fear. Do they want to get ahead of a labor market that is their preeminent concern, their one mandate Fed, or are they still at least vaguely aware of inflation that's still kind of out there?
Super fired up about this, aren't you? People getting bullish in the last 24 hours. Maybe that's what sort of got Bramo started. Evercore dropping its call for a hard landing in the US economy. That's Ed Hyman. That's a big shift from them. Deutsche Bank, Binky Charter publishing yesterday afternoon, raising his S&P 500 forecast to 57.50. So we're talking about 50 a little bit more this morning at the same time that other people on the street are getting a little bit more bearish as well.
And this is the ultimate key question to me, because we had been asking this question to a lot of people. If the Federal Reserve goes by 25 basis points or 50 basis points, what's better for this market? Most people saying 25 basis points. You know, project this sense of confidence. And now the hint of 50 basis points is actually reviving this hopes of a soft landing, because this is a Fed that wants to get out ahead of this at the same time that NVIDIA just is feeling enthusiasm and nervousness from their clients about not getting enough shipments, and that just is enough.
So much snark from you. You need a weekend. Equity futures right now on the S&P 500 up by 0.2%. In the bond market, the rally resumes. Yields are lower across the curve. We're down by about 2 or 3 basis points on a 10-year, 364.57. In foreign exchange, 110.92. on euro dollar, firmer by just 0.1%. Coming up this hour, we'll catch up with Max Kettner of HSBC saying don't pull the plug on risk. Jennifer Flitton of Invesco as Donald Trump pledges no taxes on overtime. And Bloomberg's Sid Phillip as union workers at Boeing walk off the job. We begin with our top story. US stocks looking to add to this week's $1.3 trillion rally going into the Federal Reserve decision next week. Max Kettner of HSBC writing, we don't think it's time to pull the plug on risk. We therefore add to US equities as Q3 warnings, or rather earnings expectations, also don't look challenging to beat. Max joins us now for more. Max, good morning to you, sir.
Good morning.
That's the equity call. I want to get to the credit call. There was a shift on high yield for you in the last week. You moved that overweight from max overweight to, where are we now?
Slight overweight.
Slight overweight. What's that shift
from
about?
Exciting to boring.
So what's that shift about? Let's start there.
I think, look, when we look at high yield, it's not like it's bearish. So certainly in Euro high yield, things look still pretty okay. Valuation-wise, it looks a bit more attractive. I think in US high yield, there's partly a story around valuations. You know, you have high yield spreads around 320. There's not an awful lot to go anymore. There's not an awful lot of spread tightening that you can still see. So at some point, it gets around pure carry. And then you sort of, okay, is that still the best place where I get the carry, or is other places better? such as EM local debt, for example, where perhaps, you get higher carry, it's a bit short, it's sort of equal or similarly short duration, and it looks a little bit more attractive now, given how much has been priced in since April there, similar to the Fed. And I guess, when we look at it from a total return perspective as well in high yield, if you get now these sort of 10, 11 cuts priced in by the end of this year, if you get just a few priced out, right? Like, let's say, compare high yield to equities then. If you're long equities now, if you're long the S&P, do you care whether they cut 10, 11 times by the end of the year, or they cut 7, 8 times by the end of next year? Not really, right? Like, that's not really the big tail risk anymore. The big tail risk, particularly in April or in September, October last year, was they're not going to cut at all, or they may even have to hike. The tail risk now is, well, maybe I'll do only 4 or 5, but they will be cutting. So for equities, it doesn't matter. For high yield, it matters, because obviously the front end of the curve goes up.
Well, doesn't it matter for EM as well? Can we get into EM a little bit more? What are the assumptions you're making on rates on the US dollar to make that call?
Yeah, I do think, however, that in EM, again, valuations are a little bit more enticing. If you look at EMD spreads in particular, year to date, so they're sort of flattish. Of course, there's been some index composition changes as well. Yes, of course, but from a valuation perspective, certainly there's a bit more juice left compared to US high yield. So we're really at the stage now where it's not really bearish about high yield and much more bullish on the other stuff. It's a bit like, okay, you're really harvesting that carry. Where's the carry best across all the asset classes?
How much is this just a revival of the FOMO trade? Essentially, look for the biggest return and go. And that's essentially because the Fed is cutting rates, and so, yay.
Yeah, pretty much. I think it's sort of the, we were saying in 2021, that it's all pretty much a YOLO world, right? And it was sort of the return to YOLO. You could argue that's sort of what we're seeing, for example, this week. But let's be honest, we could also sit, maybe by the end of next week, we could sit here and you guys talk about $1.5 trillion being wiped out again. Like, if we had this chat last Friday, we wouldn't be that upbeat. No, we would all be like, oh my God, is this recession? And, are we closer to the end now? And is this the start of a bear market? And what is commodities trying to tell us? And all this sort of stuff. And now we sit there and we're like, YOLO, everything's great. So, this is how much it shifts within a week, if we're honest.
We were having a conversation to start the show about 25 versus 50 basis points, and I wonder how much you were rolling your eyes and how much you were actually saying this is going to matter to the market.
Do you want me to roll my eyes? I don't know.
You're a happy European who actually can go skiing on his weekends. But I am curious about whether you are seeing a market that is likely to sell off in response to a 50 basis point rate cut, or respond with that cheer and YOLO.
Yeah, so it depends. I think they would have had the chance in the last few weeks to say, look, we're so comfortable with this disinflation picture. If they had, look, we're so comfortable with this disinflation picture, look what has happened since April this year. We've had super core down, we've had all these, all these components down. So because of disinflation, we could cut higher, right? We could cut more, we could start more aggressive. The problem now is that, of course, particularly with Jackson Hole, you said, oh, we're attentive to growth risks more than inflation. So the problem is, if you start with 50 now, particularly with what John was saying in terms of the data, the totality of the data, sorry, not making fun, of course.
Of course not.
Of course not.
It's not my language anyway. Why are we blaming me for that? That's Chairman Powell. Carry on, Max.
So if we look at that, then the last couple of weeks actually has been really good. Look at weekly same-store retail sales data. It's been picking up from 4.5% to 6.5%. Now, when we look at jobless claims, you look at weekly consumer confidence data. You look at some of the electricity output. Look at the Dallas Fed's weekly economic index. Look at the GDP now from Atlanta Fed. We're talking 2.5%. So it just doesn't warrant it currently. So the risk is, if you go 50 first, the market will say, what do you know that I don't? What am I missing? And I think that's what the market will take, a bit of like, oh God, I don't like this.
But Max,
I really don't like this.
Can't the chairman just clean that up in his press conference?
I think he could, but I think particularly with Jackson Hole, they've sort of missed the boat. Right? It was particularly also with Jackson Hole that they could have said, look, it's really because of inflation. It's really because of the disinflation that we're so comfortable with. That is why we could be cutting much more aggressively from the start, right? That's why we could sort of rush out of the gates and be like, we can cut 50. Yeah, growth has been a bit wobbly, but we're really comfortable with this still. It's just because of disinflation. And they sort of missed the boat on that.
Since you're visiting us from abroad, I have to ask you about the U.S. election. How concerned are you about the risks that are tied to November?
Yeah, look, not an awful lot, but because when we look, for example, at 2025, I think people talk a lot about the US election. I'm not sure how much people have positions on. Certainly when you look at our tactical asset allocation convictions, they are really not particularly tied to the US election, because I think what we're missing, looking a bit into 2025 as well, there is the debt ceiling issue looming, for example. But the Treasury has made it clear that we want to have these 700 billion stocked up in the Treasury General account in order to be able to pay that down, which could be at least perceived by the market again as temporary stimulus. You know, similar to what we had in Q2 last year, which is actually pretty good. Now, that's independent of the election. We know that in 2025, of course, there's a couple of those tax cuts from 2017 expiring. Again, that's independent of the election. We're going to have to deal with that. There is some sort of fiscal cliff awaiting us. Perhaps second half of next year when the negotiations start, there is going to be something looming. That's independent of the elections.
Any evidence from your conversations that the Europeans are willing to de-risk from US assets ahead of all of that? Are they concerned about it?
No, not at all.
Not at all?
Not at all. I think if anything, we've seen in the last, particularly, let's call it 5 months, we've seen the opposite. I think we've had this sort of long Europe trade into April, call it April, May. Long Europe, perhaps long Japan, a bit of diversifying. Oh, is the ex-US outperformance, is that really now kicking off? And in fairness, when we look at all the activity data, when we look at the high-frequency data, it's really strong still in the US. We're talking about the fiscal picture, the fiscal support. It's really strong in the US. Look at what Draghi was saying this week around, come on, we've got to be supporting more, right? We've got to be supporting more. And where it's happening is here. It's in the US. So if anything, you know, then you've got this, you had the French elections, of course, so there was these sort of concerns around that as well, whether unwarranted or warranted, don't care, but all of that really led a little bit more the inflow picture back into the US.
Max, it's good to see you here in New York. Thank you, sir. Good to catch up. Max Kenner there of HSBC. Futures positive on the S&P 500. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Boeing factory workers have walked off the job in the first strike since 2008. Members of its largest union, which represents over 33,000 employees, voted overwhelmingly to reject a contract offer and then walk off the job. The offer would have raised wages by 25% over 4 years and lowered employee health care costs, but union members expected a far greater increase. Both parties have expressed interest in getting back to the bargaining table. House Speaker Mike Johnson is likely to need support from the Senate in order to avert a government shutdown later this month. Hardline House Republicans rejected Johnson's stopgap funding bill this week. The deadline, September 30th. Former President Trump has vocally called for his allies in the House to reject a continuing resolution unless it includes a separate bill requiring proof of citizenship in order to vote. Nippon Steel and U.S. Steel sent a letter to President Joe Biden earlier this month on the Japanese company's proposed takeover. The letter was signed by both company CEOs. Nippon Steel has been mounting a last-ditch effort to try to muster support for that $14 billion takeover attempt. It still, though, faces widespread political opposition in the U.S. ahead of the presidential election in November. That's your brief, John.
Hey, Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, another rally, another tax cut.
As part of our additional tax cuts, we will end all taxes on overtime. That's what we're doing because this is a good one. And I think it's going to be great for the country.
In 2 months, there'll be no taxes left. That conversation up next from New York this morning. Good morning.
bigger challenge listens next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Live from New York City, welcome to the program. Equity futures on the S&P 500 firmer here by 0.2%. Bond yields moving back in. We're down 3 basis points on a 10-year, 364.57. Under surveillance this morning, another rally, another tax cut.
As part of our additional tax cuts, we will end all taxes on overtime. You know what that means? The people who work overtime are among the hardest working citizens in our country. And for too long, no one in Washington has been looking out for them. It's time for the working man and woman to finally catch a break, and that's what we're doing because this is a good one. And I think it's going to be great for the country.
So here's the latest. Donald Trump looking to turn the page from Tuesday's debate with a pledge to end taxes on overtime wages after 40 hours a week. The Trump campaign moving on to California, with the former president set to hold a news conference and a private fundraiser. Joining us now to discuss is Jennifer Flitton of Invesco. So Jennifer, I've got to ask you, how long before we see a rally with the vice president and she opens up with, we will end all taxes on overtime?
That's right. She did follow him on the no taxes on tips, so we'll have to watch this one closely. I think she's pointed to some Department of Labor regulation that happened under his administration. I think she wants to move more towards the regulatory side than he on the tax cut side. So we'll have to see. Stay tuned.
Jennifer, what we've heard so far from the Trump campaign, and then to John and yours point, copied in some extent by some of these from Kamala Harris, is it's going to be about $4 to $5 trillion in just extending the 2017 TCJA tax cut law. There's going to be ending tax on Social Security, no tax on tips, lowering the corporate tax rate to 15%. Now he's proposing no taxes on overtime work, and then you have to add in what J.D. Vance is calling for an expansion of the child tax credit plan. Out of this entire smorgasbord of cutting taxes, what actually can get done, do you think, in 2025?
Right, you're right. There is a huge amount, 4.2, some have estimated 4.5 trillion by the time we actually get to it. The negotiation over the provisions that are expiring in 2025 on TCJA, and it's going to it's going to be mostly determined by the makeup of Congress, right? So if Trump does come in and he has a Republican trifecta, meaning a majority of Republicans in the Senate, majority of Republicans in the House, that allows for the reconciliation process to happen, and that's not going to be simple when you have $4.2 trillion on the line here and a lot of aspirational promises. But if you do have divided government, whether that's Trump in the White House or Harris in the White House, it's going to be much tougher negotiations in trying to get some sort of extension past 2025.
So what is your base case as of now?
Well, I have to know what the makeup of Congress is, but I think I do know that the likelihood of the Senate is that it's going to be a Republican majority, right? The Cook Politico report has now sort of given a lean Republican to the Montana seat. We know West Virginia is consensus is it's going to be a Republican seat. So then you have 51 right there. But these are slim margins. We'll see if Republicans can add to that in possibly Ohio, possibly Maryland, possibly up into Michigan. We'll have to see. But even if they get to 52, 53, you're talking about a really tight negotiation. And the House, whether it's Republican or Democrat, it's going to continue to be very tight margins. And getting things done in those tight margins, it's very difficult. So tax is definitely going to take up all the oxygen in the room next year.
Very difficult, especially considering right now they're still debating on whether or not they can keep the government open until the end of the year when you're looking at the makeup of Congress. When Trump comes out and talks about this, he says it's about getting blue-collar workers a break. This is something he ran on, we saw in 2016, 2020. Is it still going to land a punch this time around?
Yeah, I think this time around, what is affecting voters most and what we're seeing in the polls and what we've consistently seen over this past year in polling is that fundamentally the issue that is driving folks to the polls is the economy and how they feel in their pocketbooks, right? The tightness. And so any sort of promise for relief, I think, is what both of these candidates are trying to reach working class voters with.
I was looking yesterday at the bond auctions and the day before and the day before. It seems like markets are not taking any of these proposals seriously. Would you agree with that?
Well, I think that these are aspirational promises. So I think that's exactly what you're hitting on here, right? And this is what elections are. These are if I had my way, and we know that's not how government actually works, that there is a checks and balances. It is a negotiation with Congress. But you do have priorities of both of these candidates that they're going to go into any negotiation with. And let's face it, the leverage is with those who have the mandate. And if there is a strong win on either side, then you're going to have a mandate going into these negotiations next year.
I love how you frame it, a wish list. And I'm curious what sentiment we're getting from the wish list that goes beyond just taxes. Yesterday, the former president, Donald Trump, also posted a video to X embracing digital assets, saying we're embracing the future with crypto and leaving the slow and outdated big banks behind. He's held rallies having to do with crypto. Do you understand the focus and the wish list item of crypto in his sphere?
Well, it's been really an interesting year in this area, and there has been, legislatively, the hard work. The technocrats on the Hill have been trying to create some sort of digital asset market structure, but they have had a lot of pushback from the SEC. And so I think what Trump is trying to relay,
I think we've lost that connection.
and what he has been doing in a lot of meetings with top crypto.
Carry on, Jennifer. It just cut out just for a second. Sorry to distract you, but please carry on. It just cut out just for a split second. Forgive me. Carry on.
Yeah, absolutely. So essentially what you've seen him do is really be open to the crypto space in a way that you've seen with a number of Republicans on the Hill. They've been trying to create this market structure. They've been trying to do something on stablecoin, digital assets, DeFi, blockchain in general. And he is trying to tell these folks, hey, I'm going to be the president for you. I'm going to put in an SEC chairman who's going to allow for this space here in the United States, which really they need that regulatory framework in order to take hold.
Jennifer, thank you for your thoughts. Apologies about the technical issue on our end. Jennifer Flitton there of Invesco. Jennifer, thank you. Thank you very much. I think no one takes it seriously for now. I think the base case at the moment is divided government, and if you get divided government, the tax cuts expire, and that's bond bullish. But if we wake up the morning after the election and someone's got a sweep, then I think fixed income starts to take things a little bit more seriously.
I think it's important to recognize that the market is not taking it seriously, so we can't get a real check on what the response function is going to be. I do think, though, to Jennifer Flitton's point, this idea of taking some sort of conclusion from the wish lists of what they want to do in terms of what direction things will be going in, I think that's important, especially when it comes to some peripheral industries like crypto, like Fannie and Freddie, and some other issues.
Also, what's interesting is she mentioned what's going on in the Senate. It is really starting to look like the Republicans are going to be able to flip the Senate. You have the Cook political report talking about Montana is now lean Republican. So if there was to be Harris in the White House, and then you have the Democrats controlling the House potentially, that is serious gridlock, and it cannot be progressive policy proposals, and there'll have to be serious negotiations and debates about where the tax policy is
That's
going.
bond positive. I'm not sure where that leaves equities. Where does that leave stocks?
You know, we'll see. I think that there's a sense that going forward, stocks and bonds are going to move in opposite correlation. That what's good for bonds is bad for stocks, and what's bad for stocks is good for bonds. And that basically the proposal from Harris is going to be good for bonds and bad for stocks and flip it around on the other head. Whether it actually works out that way, we'll see, because in the past, bonds and stocks have actually moved in positive correlation over the past few years. And what's to say that that's really going to shift materially going forward?
Based on current proposals, you'd have to imagine that this market would treat a blue sweep horrendously in equities. The idea that you're taking the corporate tax rate from 21 to 28, game over. Blue sweep will have conversations about taxing unrealized gains as well.
We will. At the same time, you hear other arguments that next year, if there is a blue sweep, you could also get some sort of fiscal proposal that could bolster things. And on the flip side, you get all the negative stuff up front with a red sweep. You know, you could see all the arguments being made. People can make up whatever argument they want because it's all wish list at this point.
If there's a blue sweep, though, the market would also look at it in the sense questioning, where are the centrists in the Democratic Party? Kirsten Sinema will not be there. Joe Manchin will not be there. So there is that propensity now, potentially in a Senate, to do more than they were willing to do in the past.
2 more months of this coming up on the programme. Boeing workers walking off the job for the first time since 2008 from New York City. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Four-day climb on the S&P 500. The advance continues this Friday morning. Good morning to you. Equity futures look like this, positive by 0.2%. On the Nasdaq 100, up by 1/10. On the small caps on a Russell, decent run here, up by 0.75%. Thank the bond market. Front end of the yield curve, the 2-year yield down for a second consecutive day. At the front end of the curve, we are negative by 6 basis points, 357.83. The why? It's certainly not the economic data. CPI came in a little hot. Likewise on PPI. Jobless claims were pretty subdued. This is about the Fed speak, or rather the former Fed official speak, in the last 24 hours.
Yeah, there were three items that came out that were kind of the 1, 2, 3 punch. The first being Nick Timiraos in the Wall Street Journal writing a story, putting a greater emphasis on a 50 basis point rate cut, which is unusual given the fact that markets have basically come and coalesced around the idea of 25 basis points. Right now, the market is pricing in about a 50% chance of either 25 or 50, which is so unusual. It has been years, John, since there has been this level of uncertainty, unclarity, a sense of a real live meeting without necessarily a clear conclusion, and it comes with rhetoric that doesn't really match the market sentiment, but people are going with that because you know something I don't.
I think it's been about a year since the 2-year yield did not drop on a Fed decision down at Chairman Powell news conference. Do you remember we were counting? I think it's been about a year since that happened.
And this comes with a material shift in Jerome Powell. And can he move the rest of the committee toward his view? We heard from Chris Waller. He was open to a bigger move should the data warrant. Did the data warrant? Is it the argument you've made? You talk about the totality of data. You just mentioned that inflation is not dead. We saw, upside surprises on housing costs. At the same time, people are saying it's in the right direction, and we're hearing out on all sides of the Atlantic. Right now, it seems like it's a toss-up, but it is odd, the emphasis on a couple of articles and commentary over the past couple of days.
Yields coming in, push it through the FX market. The dollar weaker against the bulk of G10. Dollar yen down by 0.9% at 140.52. Euro dollar looks like this, slightly positive on the session to about 110.90. This from BNP Paribas saying the dollar bull run has come to an end. Our forecasts imply a gradual weakening to the dollar to 115 in euro dollar, 132 in dollar yen by year end 25. We know that these forecasts are conditioned on, this is the important piece, Lisa, a soft landing as well as a Harris presidency and a divided government. So there's a lot hinging on that idea that we get a divided government come November.
And that would essentially be dollar weaker, and that would create a bit of strength for the euro. You talk to 3 different strategists in the FX space. You'll get 3 different views. You have Morgan Stanley coming out talking about parity. You have Frederick Ducruzet of Pictet Wealth Management talking about how essentially this is an ECB poised to cut much more significantly than they're even saying, just simply because of the weakness. So, pick your poison, either a Harris presidency or Germany.
If you get tariff man back in the White House, it's dollar ripping, right? Dollar stronger.
He might not say that he wants that. He wants dollar weaker, but that is essentially what people are expecting.
Likely the consequence. Under surveillance this morning, former New York Fed President Bill Dudley saying there's a strong case for 50 at the Fed's meeting next week, citing a slowdown in the U.S. labor market with risk to jobs greater than lingering challenges to inflation. You will remember, going into the July meeting, Bill Dudley made the argument they should be cutting then. I think this echoes the fact that they didn't cut back in July.
Yeah, so how much are you trying to make up for it, and how much do you jeopardize the communication tactics by saying, we're catching up, there is a risk in the market that we're not recognizing? It is notable that Bill Dudley previously had really supported 25 basis points. So there wasn't a lot of daylight between July and September as long as the path was clear. Why now?
He said the facts have changed, didn't he? So his views changed. Let's get a move on.
Back in July.
Yeah.
But the facts haven't changed from July till September. So the question is, how much are you actually giving the wrong signal to the markets by cutting for 50 basis points? I mean, that's the discussion around 25 versus 50. Does it really matter whether you started in July or September, or is it just the signal that you're actually on this path?
We can talk about this all morning, and I think we'd all agree that there's a lot of nuance here. Beyond just 25 or 50, you can achieve the same through a 50 with a 25 by leaning very heavily on the dot plot and forward guidance. And what comes out of the news conference, and Anne-Marie mentioned this at the top of the hour, what comes out of the news conference is equally as important. So 25 or 50, I don't think all 25s are created equally. You come out at 25 and signal this is the first in a string, start talking up a destination and the journey back towards neutral, start leaning in that direction heavily. That's a very, very dovish 25.
I like the idea of heavy lifting with the dot plot. We're going to be analyzing the statement of economic projections and understand, can they cut their expected benchmark rate while also not necessarily moving the growth forecast? And if that's the case, they will be signaling that it is not because of weakness that they're going to be cutting much more significantly.
The main event next Wednesday. Elsewhere, former President Donald Trump pledging to eliminate taxes on overtime pay. The plan would boost take-home wages after 40 hours a week. Trump also vowing to cut mortgage rates to 2%, despite only limited influence over the Federal Reserve. So let's park the mortgage argument just for a second. Tax cut after tax cut. And I joked about 10 minutes ago that I'm waiting for Kamala Harris, the vice president, to come out and basically say the same thing. But that's what happened last time. Why wouldn't it happen this time?
Well, yeah, she might get asked the question, what do you think about this new policy proposal from the Trump camp? Do you also agree that those who are working overtime shouldn't be taxed? And she could say simply yes, and then technically she'd be copying Donald Trump. But as we just heard, a lot of this might not happen. I mean, it is the Oprah Winfrey election of tax cuts. It's on everything when you look down the list. Extending TCJA, on top of that, ending tax on Social Security, ending tax on tips, lowering the corporate tax rate. We are talking about trillions of dollars, and all of this feels like spaghetti on the wall to get people out to vote. Will it actually happen? A lot of this, likely not.
You said it might not happen. Arguably, it won't happen, most likely. And here's the question that I have. Have we ever had an election where people took the proposals less seriously because everyone said that none of this would happen? Because essentially that is what the market is saying, which I think is really notable. So it's sort of, why not say that? If no one's going to really cross-check it and say, we believe you and we're expecting it, it seems like everyone's just saying, oh, it's nice that you have to say this to cater to these constituencies.
The overwhelming base case is gridlock in Washington. Like, that's the overwhelming base case. And I think to some extent that's contributed to the bond market rally we've seen over the last few weeks as well. If you get anything but that, got a very different story in this market.
People don't believe there will be a material change. And perhaps it's just because you can't trade in something that you don't know. But it doesn't seem like people are taking it truly seriously in the bond market just yet.
I agree with you. Let's turn to Boeing. Some real news out of that company. Boeing factory workers walking off the job for the first time in 16 years. The strike halting production at the plane maker's Seattle Commercial Jet Hub. This coming after members of the International Association of Machinists and Aerospace Workers rejected a contract offer with 96% voting in support of a strike. Bloomberg's Sid Phillip joins us for more. Sid, welcome to New York. It's good to see you.
Likewise.
Walk us through what happened here. Why is this strike happening?
So Boeing's been in negotiations for the last couple of months for a new wage deal. So the last time they had a strike was in 2008. They've been sort of working on a brand new wage deal that is the first time in sort of 12 years that they're working on a completely new deal that would get basically their workers a brand new deal in terms of just being able to get higher wages and essentially get, because they've talked about how they've been hit by inflation and they've been working towards getting a brand new wage deal. And so for Boeing, they're in the midst of a crisis. They've been sort of trying to get out of this position for a while where they've been burning cash. They've had ever since the Alaska escape back in January when the door plug fell out. They've basically had to slow down production. And so for Boeing, they're in a very tricky spot. And they were hoping to sort of make this problem go away by sort of offering them 25% over 4 years. And they said, that's the best we can do because of our constrained position.
Yeah.
And the workers said, no, thanks, we want more.
What is the ask? Do we know precisely what the number is?
They were talking about 40% when they began negotiations. And so that was the ask initially. And there's a lot of anger about the plan to cut an annual bonus. And they were sort of hoping to restore pensions, hoping to get better healthcare. And that's the sort of position where they would like Boeing to take them.
The last two strikes we had were in the 90s and then 2008. And a lot of what analysts are saying is that this means this strike could go into mid-November. Is that what you think this can actually be, mid-November? I say that because there's a really important political calendar as well.
Exactly. I mean, everyone's watching to see how long the strike will go. And both the union and the company are desperately trying to make this happen quicker than the sort of 50 days that it took in the last couple of strikes, because any sort of stoppage for 50 days is estimated by some analysts to be about 3 to 3.5 billion in terms of affecting cash flow. So essentially for Boeing and for the workers, everybody really wants a deal to be done. It's all dependent on whether or not Boeing can actually get to where the workers want them to go and the workers accept what they offer.
Reputationally, this is a brand new CEO. How much blow is this for him? Or will investors understand that this was the cards he was dealt?
Investors will understand this is the cards. I mean, Boeing's been telegraphing that this negotiation with IAM 751 was coming up at the start of the year. So this is something that was expected, but at the same time, everyone was expecting the new CEO to be able to sort of quell this issue and make sure that Boeing can get back on track, get production going, because this will stop production for Boeing. And essentially, 737 MAX, which is their biggest cash flow generator, will basically come to a grinding halt or close to a halt. And that basically means no cash for Boeing. And so Boeing's in an even more precarious position.
So no one's listening. Who's right here? Is it the workers or is it the company? Just simply because I was reading this and I'm wondering, well, how much is this part of the problem? And the reason why you have had these lapses is because workers haven't felt rewarded and are leaving versus taking advantage of a situation. Which is it?
I think it's a bit of both. I mean, I think there is, obviously workers in the aviation industry are sort of very highly skilled workers. They're sort of very focused on quality, and essentially the industry is highly regulated. At the same time, the workers feel they've been sort of given the short end of the stick because essentially the company has sort of been struggling and they've been sort of hoping to get a pay rise, and they've been talking about how they haven't been given adequate pay rises, especially with inflation where it's at, and essentially they've had to work on this current deal where they previously lost their pensions, they've had worse healthcare, and so they're hoping to restore some of those benefits, and they are in a very good position at the moment because Boeing really needs to build airplanes, and if they aren't able to build airplanes, then it is a big problem for them.
Their strike timing historically is not the best. 2008, the last time they did this, Lisa, going into what many people are still anticipating to be somewhat of an economic downturn.
Yeah, is this sort of the peak in terms of marking the end? Yeah, exactly. And we've talked about this before. You do wonder if they're a little late to the game and whether they're trying to squeeze a company that's kind of squeezed out right now.
Hey, Sid, it's good to see you here in New York. Thanks for being here. Thank you. Bloomberg's Sid Phillip there on the latest strike out of Boeing. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Chinese government is raising the retirement age in the country for the first time since 1978. Men's retirement age will increase from 60 to 63. The women's will rise from 55 to 58. That from a report from the government. Those changes are set to take place over 15 years. It will likely slow a decline in the labor force, but it does risk angering workers who are already dealing with a slowing economy. Vice President Kamala Harris raised $47 million in the first 24 hours following her debate with Donald Trump. That amount coming to nearly 600,000 individual donors. It also comes on top of the $361 million that she raised in August, more than double the $130 million that Trump pulled in. Trump is seeking to close the fundraising gap with a series of events scheduled today in California. People familiar say OpenAI is releasing a new model capable of performing some human-like reasoning tasks. Internally, it's known as Strawberry. The tool will be able to solve multi-step problems, including complicated math and coding questions. The timing, though, it's still unclear, but a release could be available to some users as soon as this week. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, a bond market looking for an anchor.
We have excessive data point dependence. We don't have a dominant economic view, so we get swung all over.
That conversation just around the corner. Live from New York City, you're watching Bloomberg TV.
Artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Four-day winning streak on the S&P 500. We could make it day 5. Equity futures positive by 0.2%. Quite a bond market rally over the last few weeks. We're down 3 basis points on a 10-year this morning to 364. On 2s, we're down 6 basis points, almost 7 to 357. Under surveillance this morning, a bond market looking for an anchor.
We have excessive data point dependence. We don't have a dominant economic view, so we get swung all over. We are going to continue with this volatile world until we restore either a dominant economic paradigm or we restore the power of forward policy guidance.
So here's the latest. Traders remaining at odds on the Fed's path forward from here. Former New York Fed President Bill Dudley making his case. I think there's a strong case for 50. I know what I'd be pushing for. It's basically up to Chairman Powell to see how much support he has for being more aggressive. Joining us now to discuss, Kata Cedar of State Street. Kata, it's good to see you. Welcome to the program.
Thanks so much for having me.
25 or 50 next week. What are you leaning towards?
I'm leaning towards 25. However, I think there's a really valid case for both sides of the coin, 25 and 50.
Is there a stronger case for one versus the other?
I think 25 because it gives the Fed a little more optionality to speed up the pace of cuts if they need to. I think the last thing they would want to do is overcut and then be in a more of a tighter predicament.
So take us inside the State Street headquarters. Everyone agreed with you. 25 basis points was the most likely. And then the Wall Street Journal article dropped.
Yes.
And then the Financial Times front page. The Fed really considers 25 or 50, seems more on the edge than what markets were projecting. Then Bill Dudley comes out. How much do you guys turn to each other and say, this seems like a signal?
Yeah. I think at the end of the day, we have to look at the level of data that we have. So, for example, the claims data this week. Initial claims signal that the labor market is still in an okay spot. And when we look at the CPI data this week, you have to look at core and the housing component as well. And I think it gives a little trepidation around, is inflation really under wraps?
So I guess that this is the argument that we hear from a lot of people, which is why the market coalesced around 25 basis points, which was the reason why people were so surprised to see that 50 was so squarely on the table. I guess, has the totality of data changed in terms of the Fed's reaction function after Jackson Hole?
Yeah, I think it's still data dependent, and because we have that data dependency and the data that we've gotten since Jackson Hole really hasn't screamed recession, that makes the case for 25 instead of 50.
This 2-year yield has dropped a lot over the last month. It's dropped a lot again over the last few weeks. We're down to about 358. The yield curve, 2s versus 10s, is positive 7 basis points. That's a recently new development, pretty fresh over the last few weeks. I think the first time we've seen that positive in the last 2 years. You're looking for the potential here for a bear steepener. Just walk us through what that bear steepener is and why you think long-end yields could actually start to inflect higher.
Yeah, so on the short end, I think you have the case where, all right, you have an economy that's still okay. You have really strong GDP forecasts. Maybe we need to take some of those cut expectations out. And then on the long end, you still have some concerns around recession as well as fiscal concerns, I think, that are a bit longer term.
Let's get to the fiscal concerns.
Yeah.
Does the election make a difference?
I think it makes a difference for the bond market, rather. Equities, I think, are a little bit more nuanced. In the past, we've seen the initial knee-jerk reaction kind of reverse, but I think that fiscal question is going to become a concern regardless of who's in Congress and who's president.
What is your base case at the moment?
That's a tough call. Fortunately, I am not our go-to political expert. However, I would say I think that's why in the equity space, we're really, really focused on what's happening on the monetary side of things.
When it comes to what happens with policy next year, you have Kamala Harris talking about a 28% tax cut, Donald Trump talking as low as 15%. So you look at all these notes, Goldman Sachs, RBC, they're saying this means for the S&P 500, it's going to be potentially good under tax policy of Donald Trump, less so under Harris. But then you add in things like tariffs, and some analysts will say if there's a Trump presidency that's going to be inflationary and the Fed may actually have to hike, if there's a Harris presidency, she's going to go lean less hard into tariffs, even though she might use them, and the Fed may actually continue on a cutting path. How do you put all of these different potential policy objectives in one place ahead of the election? Where do you hide?
Yeah, I think when you take in the fiscal side of things and the monetary side of things, and you look at what's driving markets right now, there's a lot of different variables. And because there's a lot of different variables, I think you have to lean on the side of slightly risk averse. And what I mean by that is we're not as risk averse as we would say in some other cutting cycles. However, you know, I think it means this isn't a buy everything situation. So earlier in the summer when we saw small caps really rally, we were kind of questioning that. Why is that the case? And simultaneously, I think we still can see an environment where equities do okay, but we need to be selective. And so what that means is really going to places of quality. And that's where we want to hide because of this uncertainty around elections, monetary, hard landing, soft landing.
You talk about utilities in your note. On this program a lot, we talk about whether or not that's defensive or actually growth, because how tied it is to the AI revolution. How do you view that sector?
I think it's kind of in the sweet spot, actually, where it can benefit from some of this AI trend, but you still do have some of those defensive qualities. And so I think that's actually a good thing right now, where it's a little bit on the fence of both. But given where we see tech going and that pull, it actually makes utilities a little more attractive, I think, than years past.
When you take a step back, would you say that right now the bigger risk in markets is actually inflation than, say, some of the hard landing discussions? And I ask this because person after person has come on and said they're not worried about runaway inflation, but this feels like a market that's gotten overly complacent with the idea that it is truly dead.
Yeah, I think it would be a mistake to ignore both sides of the dual mandate. And I think a year ago or 2 years ago, when there was an emphasis on inflation, it's because inflation was really extreme and the labor market was really tight. As we've gotten closer to balance, you know, I think the degree with which that you can really focus on one or the other shifts, and you need to keep both in perspective. And the case to only focus on one is much different now, and I think you really can't forget about that inflation component. And we saw that in the report this week.
So when you take a step back, if you see inflation as the bigger risk, that would seemingly suggest that bonds are in a worse position right now and stocks are actually in a better position, because we've seen stocks do really well with inflation and with pricing power. So wouldn't that arguably be sort of bonds bad, stocks good, at least on a tactical basis?
I think it's nuanced. I think I think nuanced is the word of the day, word of the week, word of the month. Within the equity space, I think it comes a lot down to concentration and where you want to broaden out. So what I mean by that is on dips, you still like tech. When the market is at highs, that's an opportunity to shift into some of these defensive spaces. You know, and I think at the end of the day as well, avoiding some of those cyclical places within equities makes a lot of sense.
Kata, it's good to see you. Thanks for coming on the show.
Thanks so much for having me.
Thank you very much. Kata Sita there of State Street Global Markets. You can feel the tension right now in some of the research on Wall Street, the difficulty that people are having calling this market. Ed Hyman of Evercore, renowned economist in Wall Street for decades, said this: very difficult decision to raise the forecast. History and experience say to stick with a hard landing outlook, but he's not sticking with it. He's now looking for a soft landing, and he offers a whole bunch of reasons. In fact, Lisa, he offers 10. So allow me to go through the arguments for a soft landing, according to Evercore. Unemployment claims are still very low. The economy is still awash with liquidity. Consumer net worth is still advancing. Inflation is slowing and lifting real consumer incomes. The solid consumer income proxy, advancing corporate profits, boosting employment. Fed funds likely to be cut next week, 25 or 50. Global short rates are already declining. Seeing that again on the board this morning. Housing's still okay. And then you've got this massive AI build out. You put it all together and he's abandoning his hard landing call.
Well, and most people are. I mean, the only person I can think of off the top of my head is Andrew Hollenhorst, who's still is really leaning into this whole hard landing and talking about the need for the Fed to go much more aggressively. Key question in my mind is less who's right, because we're not going to know for a while. It's where are the risks building to what's priced in and what's not. And honestly, fewer and fewer people are talking about inflation at a time that rates are making a really dramatic historic rally. And that, I think, has to come back on the table a little bit more as you talk about long-term, what is the destination, which is a question, frankly, that the Fed has not been willing to really address.
You mentioned Andrew. His mind might change again next week based on US retail sales. Your week ahead looks like this, by the way. It's worth going through. So a little bit later this morning at 10 a.m. Eastern Time, we'll get UMich consumer sentiment numbers. Then we'll hear from the presidential candidates over the weekend. On Tuesday, the big data point, retail sales. Retail sales data. This final piece of information, just as the two-day FOMC meeting kicks off and concludes on a Wednesday. And for Andrew, if that comes in very soft, then maybe if you're looking at a very finely balanced decision, maybe that's enough just to tilt things in one direction versus the other.
And certainly, Andrew probably has company based on some of the rhetoric that we've heard out of articles, as well as Bill Dudley, where it seems like Jay Powell really does want to cut more aggressively because they feel like they should have maybe cut in July as well. Key question, though, again, we keep going back to it. If there is weakness, why are we not seeing it? And I think that's an important question. If there is weakness, why are we not hearing it from the retail CEOs who still are saying the consumer's hanging in there? Why are we just hearing about discretionary spend and competitive edge much more?
Choiceful word of the moment for them. Jobless claims still subdued. That's still a big takeaway, I think, for many of us. Equity futures on the S&P 500 pushing higher by 0.25%. 4-day winning streak on the S&P 500 into Friday, looking to make it day 5, up 0.2 on the S&P. On the Nasdaq 100, up 0.1%. And the outperformance on the Russell, the small caps, up by 0.8% off the back of this rally in the bond market this morning. Up next on the program, the second hour of Bloomberg Surveillance. The lineup looks like this. Steve Orth of Federated, Bloomberg's Josh Wingrove, Sharon Miller of Bank of America, and Vishy Tripator of Morgan Stanley. All of that still to come from New York City. Good morning.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And first woman, as I understand it, first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's a very strange economy because a lot of the strength that we had, a lot of the overheating that we've had has gone away, but it hasn't really been replaced by any obvious weakness.
The odds of a hard landing in the Fed's odds have tipped higher, but they're not terribly high just yet.
The Fed must be aware that if they go aggressive here, they're in danger of undermining consumer confidence.
The market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table.
At some point, volatility spills back to the real economy. And the only thing keeping this real economy going right now is the labor market.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
4-day winning streak on the S&P 500, looking to make it day 5, live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, with equity futures up by 0.25% on the S&P and some real outperformance on the small caps. The Russell looks like this, up by 0.75%. The small caps not the dominant story, though, this week. The Nasdaq 100 heading towards its biggest weekly gain of the year so far, up by around about 5%. Thank the bond market, the two-year yield is down another 5 basis points this morning, 3.59, even with hotter CPI, even with hotter PPI, and even with jobless claims staying pretty subdued, Lisa. The data so far this week does not scream, let's go 50. It says, I think we're going 25.
But it seems like maybe people have other ideas, which is the reason why the market is now pricing in an equal chance of 50 versus 25, which would be really the first time going back years since we've actually seen a live Federal Reserve meeting. I just want to point out, you pointed to all the data being okay. Two-year yields are down more than a full percentage point from the end of June. It just gives you a sense of how far we have come down as people reset their expectations for the Fed and the destination as well.
In the commercial break, I was counting. I think we're at 7 consecutive meetings that the two-year has rallied. The yield has dropped on a Fed decision day. Chairman Powell likes to outdove where the market is. Is that where we're going on Wednesday?
That's the reason why that feeling was the reason why Bill Dudley's words carried so much weight. Does this Fed chair have the ability to convince the rest of the members to go more aggressively? That's the reason why the Wall Street Journal and the Financial Times articles got people's attention, because suddenly you started talking about the idea of insurance cutting to get ahead of potential weakness.
When Dudley came out and talked about this, and he says it's basically up to Chairman Powell, it feels like Powell wants to go there. Can he bring the rest of the committee along? And then he says the question is, why don't you just get started? Dudley is starting to sound like Neil Dutta. Get on with it, this Federal Reserve.
I think a lot of people are on the same page as Neil Dutta. Neil Dutta has poured freezing cold water over this idea that if you go 50, you're signaling something really bad. What does the Federal Reserve know that we don't? He does not approve of that message at all.
I love what he was saying. If you really believe that, you should not cut at all and give ultimate confidence to the rest of markets. I mean, he doesn't believe that, and I would argue, I don't know that the market believes it either, because just we got the hint of the idea of the market coalescing around 25 basis points, and then equity is selling off. And that I thought was a really interesting knee-jerk move. Arguably, it's just algos doing algos, but at the same time, how much does that really support the fact that this market is looking for bigger moves?
For the first time in a long time, we have a live meeting to look forward to. Equity futures on the S&P positive by 0.2%. We gave you a snapshot of the bond market rally. 10-year yields are lower by 2 or 3 basis points to 365.32. The lineup this hour looks like this. Steve Orth of Federated on why the Fed needs to cut by 50. Sharon Miller of Bank of America on how small businesses are preparing for rate reductions. And Vishy Tripatura of Morgan Stanley looking for markets to dip and then rip. We begin with our top story, looking ahead to next week's Fed decision with the call to go 50 or 25 basis points still finely balanced. Steve Orth of Federated Hermes writing they need to cut by 50 next week, but probably won't. If they don't, the next 6 weeks of data will likely push them to do so in November. And for sure, we're now entering a prolonged cutting cycle. Steve joins us for more. Steve, it has been too long, my friend. It's good to see you.
Likewise, John.
Thanks for coming in, sir. Let's talk about your call. Massive week for tech this week. Big tech, the Nasdaq 100 up by around about 5%. You like the small caps more, I understand from your research. Walk us through why.
We think the whole groundwork of this bull market that we've been in tech is shifting underneath our feet here. If you look at, I call it the 5 big things. Number one, you've got the Fed entering a cutting cycle. We've been in a hiking cycle. The economy is clearly softening. The labor market is softening up. It had been tight. Inflation has come way down. We're closing in on the Fed's target, which I think is 2.5. The yield curve is reinverting. This is huge for what works in the market. We can go into that if you like, but that is very big, and that's happening under our feet. The yen carry trade is over and is reversing, and it didn't happen in one day. It is going to unwind over several months. That was very supportive of tech. The relative earnings growth of the tech sector versus everything else is reversing. So you add all that up, all the factors that have lied underneath this bull market in, say, the new economy, the tech stocks, are underlying. And you've got this election coming, and that potentially, well, we know if nothing happens that rates are, taxes are going higher, and probably the regulatory regime is going to get even more difficult. We'll see. It depends on who wins the election.
3 things to unpack. The big tech call, things reversing, the yield curve, and then we get to the politics. Can we start with number 2 and the yield curve? Fed funds right now is at 550. The 2 years at 360. Mike Wilson of Morgan Stanley was on the program earlier this week and said, unless that spread closes, either with the Federal Reserve getting aggressive or the labor market data coming in much better than anticipated and the 2-year yield climbing again, that this stock market's going to struggle until we reconcile and resolve those differences. Do you not agree with that?
So I don't always agree with Mike, and he tends to lean bearish, and as you know, I tend to lean bullish, but I kind of agree with Mike. Yeah, we are in a difficult environment here because the Fed, as usual, this Fed is behind the curve. They were behind the curve. I mean, we were out there in 21 with others saying they got to get going. They were way behind the curve. They waited a year. They had a lurch at that point, 75, 75, 50. And now they're in the same position. They're looking at everything with a rear view mirror. The inflation numbers are already at where they need to be. The labor market is really soft right now. The manufacturing sector is technically in a recession. The China economy is in a recession. Europe is probably close to that, or whatever you want to call it. So the Fed is way behind the curve, and they're probably going to do 20. I agree with Neil, by the way. The market isn't this stupid. The market knows the data. They're not going to be shocked if the Fed does the right thing. I disagree with that, but they're not. I don't think they will. I think this Fed tends to move slow. They're watching with a rearview mirror, but by November it's going to be obvious that they should have cut, and they'll probably do 50 in November. We're going to get to. I keep asking my bond people, where are we getting to? We're getting to probably a Fed funds rate of 2.5 to 3 on this cycle. So we have a lot of cuts in front of us. The 10-year is about where we're going to get. If the inflation rate stabilizes at 2.5, and you're back to having a 1.5% risk premium, which bond investors need, both because of Lisa's concerns about the fiscal, but also because they've just figured out you can lose 20% in bonds, which it was assumed you couldn't, back in 22. So the risk premium's back. That puts you at 4, 3.5. I mean, we're kind of there on the 10-year. So that's the inversion, because what's going to happen here is the short rate is now coming down, and instead of being the short rate, 100 basis points above the long rate, it's going to be back to 100, 150 below the long rate. That changes what works in the market. So the tech stocks, they don't need financing, right? They're cash flow generators. Everybody knows that story. It's the old economy that finance themselves short, the asset-heavy businesses. They've been getting pummeled by these high financing rates. The housing market's been pummeled. The auto market, we saw this week, Ally having trouble. So when rates come down, it's going to really help the old economy stocks. That's why we're calling for this great rotation, if you will.
We've been trying to wrap our heads around the idea of betting on the recovery before we have the dip. And that's sort of what the likes of yourself and other people who believe in the great rotation are basically calling for, that you should go into the areas that will benefit from the remedy to a problem that hasn't been fully revealed. How do you reconcile that?
Well, okay, Lisa, the great rotation actually is into value, right, and small cap. Half of value is defensive. So there's a little bit of diversification in this call. Like our dividend fund, as an example, is up 18% year to date. And it's all happened since this rotation started at the beginning of July, literally. So there is some defense in there. But you're right. That's why we put out that piece earlier this week about the enter the 2 R's. What we're starting to worry about, given how the Fed is behaving so slowly, that they could put us in a recession, not a rocky landing. We've been talking about a rocky landing. And that hurts the cyclical call, which is in the value rotation. So it's kind of either a recession or a rotation. We're still on the rotation, but you're fair to bring that up. That is sort of the issue right now.
What would be the tipping point? What would you have to see to say that maybe move away from the little r of rotation to the recession call, especially if the Fed only moves by 25 basis points on Wednesday, and then you start to see the data continue to weaken?
Well, I think they'll then do 50 in November. They have so much room to go. I think they can avert a recession, but I am nervous for sure, given how they're managing things. Now, they might surprise me and everybody else, not everybody else. The market's now almost getting to 50 next week. I think that would be a wonderful outcome. Then you'll see this rotation trade really rip, because that's a good thing.
Can we talk about the politics? How much is the small caps?
Love to talk about politics.
How much is the small caps trade also tied to potentially a Trump presidency?
Absolutely. So the politics helps the small caps, right? He's sort of old economy guy, if you think about it. Biden, Harris, new economy folks. So if you get a Trump sweep, which is not obvious here, but if you did, that would certainly add fuel to the fire, because he's going to cut regulation. Regulation disproportionately hurts the smaller companies because the compliance costs are the same, rather how big your revenue base is. So it's going to help the small cap trade. It's going to help the old economy. You're going to get more of a tax cut. That helps the old economy stocks. So yes, absolutely.
When you think about the tax cuts, you mentioned them earlier, TCJA expiring. You said that you can't really put any weight on those tax cuts coming back into play. Basically, we flip back up to higher rates. But Kamala Harris has also said she doesn't want to raise taxes on those making under $400,000, and she also is calling for 28%, which is higher than a rate in the 30s. So could you start baking in some of those scenarios as a base case, regardless of who wins? There are going to be some provisions.
Yes, that's right. I agree with that. Yeah, it's probably going to end up somewhere in between. But if on the small cap trade, most of those smaller companies are paying taxes based on high income tax brackets. They file as individuals. So she's for sure going to raise those taxes if she can. What the market doesn't fully grip here is that this is a tax hike that's on autopilot. It's usually the case that you go, well, I don't know who wins the election. You got to have the majority. Maybe they'll do a tax cut.
Oh, no, they expire.
Yeah, they full stop. They all go up. And now we're negotiating which ones don't. She leans more towards, let them all go up. That'll be her trump card, if you pardon the pun. He leans on cutting. He obviously likes them where they are. So you guys are talking about this. Yeah. It looks like Montana is red, and probably you're in a divided government, but very tight margins. Someone at your show mentioned this earlier this morning. It's not clear, so I think that the market's going to have to digest that. It's not clear where that's heading.
Steve, it's good to see you.
Likewise.
Got to do this again soon. It's been too long, which I think is your fault. Steve Orth, Federated Hermes. Steve, thank you, buddy. Equity futures on the S&P 500 up by 0.2%. Let's give an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Chinese authorities have banned PwC for 6 months and also levied a record fine of $62 million over lapses in its work auditing Evergrande. In March, China's securities regulator had said PwC approved Evergrande's accounts, even though the developer had inflated mainland revenues by nearly $80 billion from 2019 to 2020. PwC said its top executive in China will step down in the wake of the scandal. Shares of Adobe trying to find its footing, but down some 8% in the pre-market trade following the sales outlook that disappointed investors. Investors were eager to see that the software company, which is known for programs for creative professionals, can make money from its tools. Adobe has focused on implementing AI into features and products like Photoshop and Illustrator, but the broader software sector has been seen as vulnerable to startup rivals and taking businesses from traditional companies like Adobe. Gold at yet again another record high. The precious metal is on track for a weekly gain of almost 3%. The surge has been boosted by expectations around a widely expected decision from the Fed to cut next week. Gold buying from global central banks and strong haven demand also been helping the advance, alongside shorts getting squeezed. That also might have contributed to the metal's rise in value. And that's your brief, John.
Danny, thank you. 25.68 on gold. There has been one consistent tailwind, central bank gold buying. Danny mentioned it, big feature of this move over the past year.
And it's a structural shift, so when it begins, people forecast it to continue. And I'm thinking about China in particular, but also other countries that would like to diversify some of their FX reserves.
Another all-time high. Up next on the program, attempting to settle the debate about the debates.
I believe we owe it to the voters to have another debate.
We've done 2 debates, and because they were successful, there will be no third debate.
That conversation up next. Live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
From New York City this morning. Good morning. Equities right now positive, just about by 1/10%. Just a couple of upgrades in the last 24 hours. Had one yesterday from Deutsche Bank. Binky Charter raising his S&P 500 forecast to 5750. And Lisa, just moments ago, we got another one.
Yeah, from Michael Purvis over at Tauback & Capital. Moving from the call that they had last December of 4,800 to 5,800. Again, we're talking about forecasts now of about 3 to 4% gains from here, from current levels. So this is a bit of a catch-up, but it highlights the sort of capitulation to the YOLO, FOMO kind of moment that we're really in the equity market.
It's leaning bullish, going into a big Federal Reserve decision a week away. In the bond market, the rally continues or resumes. Yields down by 2 or 3 basis points. The 10-year 364.76. Under surveillance this morning, attempting to settle the debate about the debates.
Donald Trump and I had our first debate. I believe we owe it to the voters to have another another debate.
She immediately called for a second debate, which means that she was like a prize fighter that lost a fight. We've done 2 debates, and because they were successful, there will be no third debate.
So here's the latest. Trump and Harris hitting the ground, running with a busy schedule of campaigning following their one and only debate. Trump holding rallies and fundraisers in Arizona, Nevada, and California, with Harris honing in on swing state voters with a return to Pennsylvania once again today. Joining us now is Bloomberg's Josh Wingrove. Josh, no debate or a debate? What's on the table at the moment?
My money is on no debate right now. Trump seems to have drawn a line in the sand. However, as we know with Trump, nothing is final. It can always change. You never know. This is, of course, a big flip. You talked about sort of YOLO and FOMO. Trump was going, anytime, any place with Biden. He wanted like a million debates, it felt like, back then, just a few months ago. Of course, the first one set in motion Biden's exit from the race and brought in Harris. I think, the results of this, pundits are saying that Harris won it. We're waiting to see a lot of polls to see if voters agree. But right now it's Harris sort of begging Trump. So the tables have flipped. Doesn't look like we're going to get that. We will, of course, get that VP debate. So that's at least something for those, anxious for their fix on debate.
Josh, not to go into full-on scenario analysis, but if Kamala Harris, because you know these 2 individuals, if Kamala Harris came out and said, I'm willing to do a debate on Fox News, would then Trump show up?
It's a good question, because Trump yesterday did float Fox, and he floated NBC as options. Fox, of course, much more friendly to conservatives, typically extremely friendly in certain corners of Fox News. So Harris would have a calculus to make. She has not paid a lot of interest in the past to his previous offers to do Fox. Of course, his September 4th town hall that he did with Sean Hannity was initially unilaterally announced by Trump as a debate, and the Harris campaign sort of laughed it off as not a serious proposal. So if she was to say that, I think Trump would consider it because he thinks it would be friendly territory. However, she's shown no interest in it until now.
So, Josh, let's talk about where Kamala Harris is going. Pennsylvania. She continuously goes to Pennsylvania. So I read that they don't think they're winning that state right now. Is that accurate?
Pennsylvania looks like it's increasingly the ball game. The polls look really good for them in Wisconsin and Michigan. And the question is, how do you get those other 19 electoral college votes? Well, magic number, Pennsylvania has 19. So to win, she either needs Pennsylvania or she needs some combination of other states, Nevada, plus either North Carolina or Georgia would get her there. Those are, of course, traditionally less blue states, although some polling has her competitive or even leading recently in North Carolina, for instance. You're going to see both of them in Pennsylvania all the time. And the question here, we've been talking a lot about what Harris has done since Biden left, right? A lot of the polls are up. The fundraising is way up. She's, more enthusiasm among certain blocks of voters. Joe Biden was from Pennsylvania. This is a state where the other side of that coin could come into play. Does him leaving the ticket, even with all the concerns about his age and his debate performance, impact things, in particular Northeast Pennsylvania, where he's from? Or can Harris put together the coalition that has won there in the past by driving turnout in Philadelphia, in its suburbs, and kind of holding the line throughout much of rural Pennsylvania, which skews, more Republican, a lot whiter, that kind of thing. So we're going to see them both in Pennsylvania all the time. And of course, that is putting a lot of eyes on issues in Pennsylvania, including that U.S. Steel deal that we've been talking so much about.
There's a question around how much Kamala Harris is actually playing catch-up after not selecting Josh Shapiro as her number 2. Is that part of how you read some of the tours of Pennsylvania?
Yeah, it's the big question. I mean, her picking Walz is a bid that he can have broader impact in broader states rather than picking one guy that she would want to deliver one state. Now, Harris's team seems delighted with Walz. They don't want to leave any impression that they're sitting here with second thoughts. But hanging over this all is if they lose Pennsylvania and can't fill it in with one of those other scenarios like North Carolina and Georgia, then the Monday morning quarterback question after the election will be, could Shapiro have won this for them? And of course, that will tee up a lot of questions leading into 2028 about whether Governor Shapiro will run and if he'll be a top-tier candidate. Of course, he would be a very high-tier candidate if he did decide to seek the nomination in that scenario. So it's just everything, so much attention on Pennsylvania always. It just feels like more and more so. But things can change so much. Of course, 6 months ago, the war in Gaza, was the Israel-Hamas war, was impacting things in Michigan in particular. Now Michigan is consistently looking like it's in pretty good shape for the Democrats. Of course, no one knows entirely, so things can change really quickly, but we only have, 53 days to the election.
Can things change very quickly for Nippon Steel as soon as the election's over?
Yeah. If they get an extension, this is the big thing. The timeline is the big question for them right now. There was a big meeting this week. Maury, the executive vice president who's been handling this, flew to Washington for meetings, and people have been reading the tea leaves on this. And right now, there are not a lot of tea leaves to read. But the question is, Joe Biden has pledged to kill it. Our reporting and the reporting of others is that he plans to block it once it reaches his desk. As of Wednesday, it had not reached his desk. We haven't had an update since then. The question is whether an extension will push it, because otherwise analysts think, people watching this closely think that deadline is coming up pretty quick before the election. So the choice it seems here is, does Biden have it hit his desk before the election and make the decision before the election, or is an extension granted and this drags on past the election, and then it's a different environment, obviously. I should note Harris, of course, is echoing Biden's position, which is they want U.S. Steel to remain domestically owned.
Yep.
They've not been swayed by the proxy board that Nippon Steel has offered. Trump has just outright pledged to block it.
It would be nice if we had a sequence of questions on that in the debate on Tuesday night, but we didn't, Josh, and maybe we won't get another debate again. Josh, I've got to ask this. If Harris loves debate so much now, why does she still seemingly hate interviews?
That's a good question. I mean, I'm ready anytime, any place, man.
I feel the same way.
Yeah, good. I'll put in the word. They are going to do more. They announced yesterday, in particular, either constituency or local media in battleground states. She's also going to go talk to the National Association of Black Journalists next week. Remember, there was some to and fro about that a month or two ago, and Trump went, and it was, let's say, an explosive interview that caused a lot of head scratching. So she is starting to open the aperture a little bit. We'll see how far that leads. Right now, it's about 3 or so, if memory serves, interviews. She's done 1 national interview. It's not a lot.
Not a lot at all. Josh, thank you, sir. Josh Wingrove there of Bloomberg on the latest. Some might say it's nothing. It's nothing, really. 1 interview, it's pretty pathetic.
You ought to be getting your message out and answer questions, especially if they weren't necessarily answered during the debate.
Caveat, 1 interview with a human shield with Governor Walz. That's not fair. There really needs to be a one-on-one interview.
Sharon Miller of Bank of America up next, and certainly not on this.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
2 hours away from the opening bell, stocks are positive by 0.2% on a 4-day winning streak on the S&P 500. This could be day 5, up by 0.2%. The worst week of the year feels like a year ago, and it was last week on the S&P 500. This is the bounce back this week, heading towards a week of gains on the S&P 500 and potentially on the Nasdaq 100. Lisa, the best week of gains of the year so far.
Driven by NVIDIA, right now we are about 1% away from the all-time highs in the S&P 500 with a series of upgrades from the likes of Binky Chadha over at Deutsche Bank, as well as Michael Purvis over at Talbot and Capital. They're playing catch-up with a market that is now being supported by both the soft landing and a Federal Reserve expected to do what it can, to do whatever it takes to support the sense of a labor market that's resilient.
This bond market has a strong bid once again this morning. Across the curve, the 2-year out to the 10-year, yields lower by anywhere from 5 to 3 basis points. 5 at the front end, down 3 on the longer end, on a 10-year at 365, on a 2-year at 359. How quickly the conversation changes. A couple of articles here at Bloomberg, at the Journal, at the FT, quoting some former Fed officials, teeing up the prospect of a 50 basis point cut, and the market saying, oh, don't want to be on the wrong side of that.
What that shows to me is just how balanced, I mean, I hate using the sort of language of du jour, but how finely balanced the market feels like this argument actually is, and how people don't understand what the Fed's reaction function actually is in terms of trying to get ahead of some sort of weakening that has yet to be seen, or whether they are data dependent in the sense that they would like to see that weakness first. And that's really the ultimate question. You heard Steve Ott there saying, look, if they go 50, we'll be grateful. If they go 25, well, they have to signal that they've got a lot more down the pike.
For me, it's not just about the 25 versus the 50, and I think for all of us, it's about the message in the news conference. You can go 25 and achieve the same thing as you would have done going 50 by being very dovish with the forecast and the dot plot, and being very dovish in the forward guidance as well by saying, this is the first in a string of interest rate cuts. This is where we think neutral is. This is the beginning of that journey back towards neutral, and lean heavily on that kind of guidance. I think the most hawkish thing they could do next week, if you heard the kind of Chairman Powell that we heard in Sintra, Portugal at the start of summer, and you don't hear the kind of Chairman Powell that we heard in Jackson Hole at the end of summer, then you've got problems. Because in Sintra, Portugal, only around June, July, was it? He was coming out and saying things like, the labour market's strong, and that gives us time, and we can be patient to get this right. That was basically the communication coming out of the Federal Reserve. If you say things like that next week on Wednesday, when this market's very, very focused on the other side of the mandate, that would be a very hawkish 25.
Basically, that means the 25 basis point cut would come with a pretty significant equity sell-off, especially if you take a look even deeper into the statement of economic projections. They start to right-size their unemployment rate at the end of the year to closer to where we are right now. On the flip side, a very dovish central bank would be one, dovish 25 basis point would be one that was signaling another 100 basis points of rate cuts, which could happen later this year. So you just really are correct in saying the details matter.
It's a 3-part act. It's not just the 25 or 50 that you'll see in the statement. It's the guidance you get in the forecasts, if they call that guidance. Maybe they won't. And it's the guidance you get in the news conference with Chairman Powell afterwards. There's a lot to get through next Wednesday. In the FX market, the dollar's a bit weaker today against the bulk of G10 off the back of that move in the bond market. The 2-year yield is lower. That means you've got a weaker dollar against the euro, 110.86, particularly against the Japanese yen, 140.84 on dollar yen right now. We're negative by 0.7%. Under surveillance this morning, Bloomberg learning the US and UK are considering lifting restrictions on Ukraine's use of longer-range Western missiles to strike deep inside Russia. Russian President Vladimir Putin warning against the move, saying the decision would be considered an act of war.
So basically what they're discussing is actually using Ukraine deploying British cruise missiles, but they would have to use the U.S. navigational data to use those missiles. And then Putin come out and says, well, if you're even using NATO navigation, that is an attack from NATO on Russian soil. This has been a debate for months. And I remember at the NATO conference, Biden was asked about this, and I just gotten back from Ukraine, and you really heard the Ukrainians pushing for this. And Biden said no, because if they have this ability to hit the Kremlin, we couldn't allow something like that. Say they'll go to Moscow. And the Ukrainians say, we're not trying to hit anything besides Russian facilities where their jets are taking off to hit Ukrainian soil. It's a big debate, but potentially we will see some movement on this.
It's one to watch in the next few days, that's for sure. Let's turn to the latest out of China. Set to raise the retirement age for the first time since 1978, the country's top lawmakers endorsing a plan to raise the man's retirement age from 60 to 63, while the age for women will raise from 50 and 55, Lisa, to 55 and 58.
What do you do if you've got a population that's aging much faster than you're procreating?
Don't let them retire.
Exactly. Basically work forever and expect to work forever. I mean, shockingly, those ages are pretty young. In the U.S., I think it's something like 75 years old.
I thought the same thing.
I mean, I was thinking to myself, they're just playing catch up. And at what point are we all going to be working until we're 95 with the help of, AI robots in our heads that can kind of make sure that we're cognizant?
Not many politicians in the West want to deliver that message, do they?
No.
Even though their cycle is 4 years.
Yeah, I mean, basically this idea of Social Security, you can't start paying until later on, is something that we've heard just briefly introduced, and that was political dynamite. That was not exactly what people wanted to see.
Well, Nikki Haley told Joe Matthew and myself that she wanted to raise the retirement age. She basically just said where we are right now is way too young. We need to shore up Social Security. And guess what? That clip was then turned into a Trump advertisement in Iowa to remind people why you should be voting for the former president. And then guess what? Stop talking about it.
Not popular at all. Let's turn to this report from the Wall Street Journal reporting Donald Trump's allies want to make another run at ending U.S. control of Freddie Mac and Fannie Mae if he's elected in November, saying former officials of the Trump administration, as well as bankers, have been discussing plans regarding the mortgage companies since the spring. That's the latest on that report from the Wall Street Journal. Elsewhere, Bank of America's business owner report showing cautious optimism from small and mid-sized businesses as the Fed prepares to cut interest rates. Sharon Miller of Bank of America writing, rate cuts will reduce the cost of debt servicing on floating rate credit facilities. This easing of the expense environment may create cash flow capacity for expansion or investment opportunities. We're lucky this morning that Sharon gets to join us on this program. Sharon, welcome to this program. I just want to start with this one. The amount of insight that you and the team have across 1 in every 3 small businesses in America. We're worried about stress starting to build, weakness starting to materialize. What are you seeing in the businesses that you cover at the moment?
Well, you're right. We cover 3.4 million small and mid-sized businesses in the U.S., and we are the #1 lender to small business across the U.S. And so we do have a lot of insight into what's happening. In our most recent survey that we did with business owners in the spring, we found cautious optimism from our clients. And so they do expect their revenues to increase over the next 12 months. And we know that debt servicing, as you said in the opening here, will be reduced because we do expect that rates will be cut, at least our economists do here at Bank of America, 25 basis points in the next 5 Fed meetings.
So, Sharon, are you saying they've got the confidence, the expansion plans are ready, they're just waiting for small reductions from the Federal Reserve over the next few quarters?
They are, and we still see demand in the marketplace now. So I'm not saying that they're waiting entirely. There is good growth across the small and mid-sized company sectors, but they are watching that. And certainly as we see rates come down, that will improve their cash flow and certainly consumer demand.
Sharon, I got to say, I was reading this report and I was shocked, the recent report that you put out. I was kind of shocked that actually we saw such sanguine sentiment, that people were expecting to continue to hire, that they were continuing to expand, they had positive outlook for their businesses. How do you reconcile that with some of the rhetoric that we hear every single day? This is an economy that's on the razor edge of turning negative.
I think with small and mid-sized companies, so we bank clients in the business banking space from startup to 50 million in revenues. And so when you have a smaller company, you're certainly more nimble. You're able to really, think about your business, your growth, and you can pivot easily. Bigger corporations may have more, of a hard time doing that. And so that is a competitive advantage of small to mid-sized companies. And we see that come through in the data and just in our conversations that we're having every day across the desk from these clients.
What I thought also was striking was in the market, it seems like inflation is no longer a significant concern. We heard just a couple of days ago from Mike Wilson over at Morgan Stanley that it's dead. Essentially, inflation is no longer an issue when it comes to what you're seeing in bonds. Nonetheless, 68% of small business owners say they've raised their prices over the past 12 months, and on average, they've raised prices by 12%. They're talking about inflation as a more pressing concern than many other things that we talk about every day. How do you understand whether this is really a small business issue or whether maybe we're not giving enough credence to just how much ongoing inflationary pressure there actually is?
Well, there is ongoing inflationary pressure. It is a sticky issue. And so we continue to hear that. That is the #1 concern of small and mid-sized companies. And so you have seen price increases brought along because of all the pressure there. So I do see it as a concern. We hear it from our business owners, and we do feel that as we go forward and the cycle begins to ease a bit, that is going to take some pressure off.
Sharon, given that pricing pressure, how difficult is it for these small companies to keep up with the bigger players?
Well, I think that, there is some difficulty in keeping up with the bigger players, but I would say that, they also have a competitive advantage. And so, as supply chains have improved and as businesses have expanded, and certainly they've gone more online, gone more digital, they have more reach and scale than they might have had before the pandemic. And so what we are seeing are expansion plans from small and mid-sized companies, and they are competing. And certainly, they benefit from the downstream impact as well from larger corporations.
We're talking about inflation. We're talking about the fact that they're preparing for these rate cuts. When you talk to clients, what is their #1 concern right now in this economy?
Their #1 concern is inflation. And then right next to that is hiring and making sure that they have the right skilled labor, the right employees to go into their business to work. And so those are the concerns that we hear every day. We're also in an election year, so you do hear that as well. But we hear that with every election cycle. We've been doing this report for the last 10 years. And so in each election cycle, we see, concerns once the election is over, no matter who wins, no matter what party, that there's certainty. And so people can move forward. And so that's what we're hearing this cycle as well. And, I anticipate after November, there'll be certainty and people will continue with their plans.
Sharon, talk to us a little bit about how things have changed since March of last year, given all the banking stress in this country and some of the banking failures as well. How some of your clients have changed the way they do business with you, whether you've managed to attract a lot more small businesses over the last 12 months worried about where they place that cash and they want to put it with a bigger institution like Bank of America. Sharon, how much has changed?
Well, I think, listen, we are the #1 small business bank in the U.S., and we're very proud of that. We have been for the last 4 years plus. And so, we continue to stand by our clients in good times and bad. And certainly, we every day we work to attract new clients and to retain the clients we have, because this is our mission. This is where communities meet business, and that is what we do at Bank of America. So we want to be sure that we are there for our clients. We have the capabilities they need, whether it's to transact internationally, to be able to, have expansion in their business, to get a loan, to provide payments for merchants. So all of those different areas we are able to help our clients. And so we want to make sure that we're there for them, whether it be our online tools and capabilities to manage their cash flow. So we're investing in the business based on what we hear from clients and what they need.
Well, we were thankful that you managed to make some time for us this morning, and we appreciate it. Sharon, thanks for joining the program. Thank you. Sharon Miller there of Bank of America. On the latest insight into the small business situation across this country, biggest banker of small businesses, and I think we need to get into this. I was surprised to see what you were surprised to see, which essentially is there's still confidence there that we've got these expansion plans ready to go, just waiting for a reduction of 2 or 3 or 4 in interest rates, and then we can start making a move. And that inflation is still the biggest concern
for corporate America?
Basically, this flew in the face of a lot of the assumptions of a lot of people in the market in terms of the broader economy and the broader S&P 500. Question of how different this particular sector is from the rest of the universe. There were some nuggets in here, though. Yes, inflation, the number one concern. But when it comes to AI, I thought this was interesting, too. We all talk about AI adoption, how quickly it will be sort of rolled out. 37% of small business owners plan to use AI in 2024. Sounds like a lot. That's a 12 percentage point drop from last spring. So a question about the use case and whether it's actually getting diminished as time goes on.
That's a big stock market story as well, potentially for the next 12 months or so. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Biden administration has moved ahead with major tariff hikes on imports from China. The tariffs include an 100% duty on EVs, 50% on solar cells, and 25% on materials like aluminum and steel, that according to a U.S. trade representative. The tariffs will go into effect on September 27th. China has vowed retaliation against the actions, claiming the success of its EV industry comes from innovation, not unfair government support. Hedge fund Millennium Management is looking to raise between $7 and $10 billion of locked-up client cash. It will do so by asking clients to make pledges that Millennium can tap over time. Like its peers, the hedge fund has been moving to make more stable capital that it is able to access for longer. ECB President Christine Lagarde said the central bank may consider another rate cut as soon as next month. She spoke in Budapest just a day after the ECB cut rates by a quarter point. Lagarde said that an October rate cut would be warranted if the economy suffers a major setback. Still, Lagarde indicated that policymakers will remain data dependent and are leading towards waiting until December for their next move. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, divided over rate cuts.
The market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table.
The conversation just around the corner, that decision a week away.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Equities this morning positive by 0.1% on the S&P 500. Yields a little bit lower, down 2 basis points on a 10-year, 365 on a 2-year, down a little more than that. We're down 5 basis points at 359. Under surveillance this morning, divided over rate cuts.
With this lingering uncertainty, unevenness in terms of the disinflationary trend, I think this underscores the Fed's need to remain on a very patient tempered approach as we do embark on this policy pathway back towards neutral. Now, the market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table.
And then the market reintroduced it this morning. So here's the latest. Investors questioning whether the Fed goes 25 or 50 at next week's meeting. Vishy Trupatura of Morgan Stanley saying, although we're still looking for the Fed to start a series of 25 basis point cuts at the upcoming meeting, a 50 basis point cut is not off the table because our read of the jobs report sees heightened risks that the slowdown will be more than our baseline assumes. Vishy's with us around the table. Vishy, good morning, sir.
Good morning.
You've been around the world seeing clients, I'm sure. Can we just start with this massive bid and the bias to buy in this bond market for both sovereigns and corporates alike, and not just in the US, worldwide? What's behind that at the moment?
I think there is a general expectation. Two things are behind them. One is the relative value proposition between stocks and bonds. And the second is the expectation that we are heading to significant amount of rate cuts. And it's global. It's in the US, it's in ECB. So we expect to see more rate, the path ahead is for a lot more rate cuts. And I think that this basically makes, rate cuts are happening at a time when the economy, especially in the US, is not in a recession. Rate cuts are happening when the economy is clearly decelerating, but still, around 2% growth. And that's actually looks pretty good for credit. And I think main focus is really coming from the path ahead for lower rates, and economy looks good, credit looks good.
Let's sit on credit, 2 words, and they're yours, dip, rip. Why the dip before this rip? What are you looking for in credit?
I think it's a little bit of technicals in this. The technicals here come from, I said, seasonally, September is not a great month. There's some uncertainty associated with that. And as the markets are resolving the 25 or 50, exactly what the Fed resolves it eventually for us, I think we might see the relative value between credit, as in corporate credit, and other parts of credit, whether you look at CMBS or CLO or other parts of other spread products, look relatively cheap at this point. But if you look ahead further, it looks like a pretty good path ahead for credit overall.
Torsten Slok this morning putting out a note talking about how there's a lot of foreign buying of credit in particular. To just build on what John was asking about, where is the cash coming from to buy all these bonds? We were talking to Mohamed El-Erian yesterday, and he was saying this is the cash on the sidelines, kind of coming back in, away from money markets, into credit, into duration. Is that how you see it?
I think it's, the money sitting in money markets. I think the idea that there'll be money market will flow in one big swoop, I think that's misleading. It will take time, but I think when it does move, it will move more towards high quality fixed income rather than jumping into stocks. So yes, there is some of that. There's also what I would consider, especially in the US, there is an insurance company bid that's going on. So insurance companies are selling these annuity products, which are effectively fixed rate products that sit on the liabilities sit on the balance sheet, the assets sit on the balance sheets of insurance companies. They need a treasuries plus 200, 300 type of product. And that bid is become insatiable. And that's, the sales of the single premium deferred annuity products have more than tripled in the last few years. And that's a big positive technical.
Yeah. A lot of the private investment firms have been offering these. This is the hottest growing area. We've talked to Apollo about that. I am curious, though, just from a broader perspective, how much what we're seeing in credit, what we're seeing in duration, is a technical trade more than, say, a macroeconomic call? And I ask that because we were just talking to Bank of America about how inflation is still the preeminent concern for a lot of small businesses. We see in the data this week, CPI, PPA, okay, great, it didn't surge to record highs, but at the same time, on the margins, just creeping up a little bit, or upside surprise in certain places. How do you reconcile the macro signals versus the reality right now?
Absolutely. I think there's a positive technical, no doubt. But the fundamental story for credit is really strong. If you think that the macro story, as I was just saying earlier, Fed is cutting at a time when the growth is still pretty decent, 2% growth. And this decelerating but not falling off the cliff, when Fed cutting at the time of decelerating but not falling off the cliff, is actually very constructive for credit. If you in fact step back and look at, we've looked at data from 1948 to now, because we have data, because I'm a geek. I think basically what we see is that if you look at quarterly returns, excess returns in credit, and you map that with the GDP growth rate during the period, credit does best when economy is neither too hot nor too cold. The 1 to 2% GDP growth rate is the context in which credit does the best. And we are precisely in that sweet spot.
You're maintaining a short dollar yen.
Correct.
Do you think the carry trade is over?
It's very difficult to say it's over. I mean, because it's very difficult to assess how big it is. I don't know if it's over or not, but we think that the yen is the direction of yen is more driven by the direction of the U.S. rates, particularly the 2-year Treasury. So we expect that the 2-year Treasury will drive, and that's we do expect to see yen drop further.
And then also the BOJ. Do you expect them to actually hike?
Our expectation, our base case expectation, is that of a 25 basis point hike next year in January from the BOJ. Certainly, the market is assigning somewhat higher, somewhat higher rate possibility that we'll see more than that. So this, what I would say, policy divergence, which is BOJ hiking while rest of the world cutting, that actually makes this, regardless of why it is happening, we think dollar yen is going lower.
I hope we stop talking about the carry trade for a bunch of reasons. I hope we talk a lot more about the massive dollar long that's accumulated over the last few years, underpinned by US exceptionalism, particularly in the equity market, underpinned by the fact that this is where the income has been, the yield with rates of 550 in the United States versus what's available and the direction of travel in places like China or in Japan. And whether that dollar long needs to be unwound. And what sparks that? Is it 50 basis points, 100 basis points of the Federal Reserve? I think we can park the carry trade language. The idea that there's this bunch of hedge funds that are doing something in Japan that influences something in America. There's something much bigger going on that's accumulated over the last few years. How vulnerable are we to a big unwind of that?
I don't think we are that vulnerable. I mean, we don't think we are in a point where investments, dollar investments, will shift dramatically away. We are still, the American exceptionalism stands still. It very much, that thesis very much is there. We still have growth differential, meaningful growth differential. We are decelerating, but the rest of the world is decelerating much more. If you look at China, clearly the prospects don't look that good. And then you have the idea that there will be cuts, but the rest of the world is cutting as well.
Yep.
So you put all those things together, we think the dollar as a reserve currency holds, and I don't think there's we periodically hear of this. Dollar is no longer a reserve currency. We completely reject that argument.
Sticking with it, Vishy. It's good to see you, sir. Vishy Tripatur there of Morgan Stanley. Rebalancing growth differentials is going to be harder than some people make out, Bramo.
That's the reason why people are looking for that carry trade boogeyman.
The third hour of Bloomberg Surveillance. Up next.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch. plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The market overall is a little bit vulnerable.
I think there is significant downside risk here, recession or no recession.
Recessions come from policy errors.
Markets are underweighting the impact of those pro-growth policies in the beginning of the year.
Definitely balanced risks looking forward into the next multiple years.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
We're almost there. The weekend, hours away. The third hour of Bloomberg Surveillance starts right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, we add some weight to this rally on the S&P 500. Four-day winning streak. We're up another 0.2%, leaving behind the worst week of the year so far on the S&P and adding some weight to the best week of the year on the NASDAQ 100. NASDAQ 100 futures look like this. Positive by 0.02%. On a Russell, that's where your outperformance is. The small caps up by 1 full percentage point. Off the back of this move in the bond market, check out fixed income. The front end of the curve, the two-year yield is down by 4 basis points, 359.91. Let's just round it up and call it 360. Looking ahead to the Federal Reserve decision on Wednesday, 25 or 50. The data this week gave you a lean towards 25. PPE, CPI a little bit hotter. Jobless claims yesterday coming out just a tiny bit higher, but no drama. Still pretty subdued over the last month or so. Take the totality of the data, 25. Then this happens. The 13th member of the FOMC writes an article in the Wall Street Journal, and all of a sudden we start to query whether the bias is to go 50 and not 25.
There was an article that came out around 1 p.m. yesterday in the Wall Street Journal that talked about the two-sided debate around 25 or 50. Some officials have suggested they would rather speed up the pace once the economy looks like it is weakening further. Alternatively, and this is what caught people's attention, some may expect that if they do see weakness coming up, they ought to make that move now when rates are farthest from their ultimate destination. All of a sudden, just like that, 47% chance that you're going to get a 50 basis point rate cut. A real question here about whether this is guidance or whether this is just a reflection of the debate that's being had in markets right now.
I think it is highly problematic. I've said it on this program before, and I will say it again. It is very difficult to get a read on certain articles by certain authors on whether this is actually coming from the FOMC or coming from the author and the people they cite directly. And when you don't know, I think the Federal Reserve has a problem. And the Federal Reserve has a problem that's accumulated over a long, long time. It doesn't just go back to 2022, but let's take 2022 as an example. We're expecting a 50 basis point hike. We got UMIDge sentiment that week, that Friday, I think, before that Federal Reserve decision, and inflation expectations clipped higher. And all of a sudden we get an article, sourced directly almost from the Federal Reserve, leaning towards 75. Ever since then, for this whole cycle, under this leadership, we've waited not just for Fed speak, not just for economic data, But for an article from the Wall Street Journal to give us a steer as to what's going to happen on the Wednesday, I don't think anyone at the Federal Reserve thinks that that's how you should run monetary policy, and I certainly would agree with them this morning.
There is a real question right now, again, and I think you're correct, in terms of, is this a steer or not? And it was interesting to hear Jim Reed over at Deutsche Bank saying that this echoes, as you said, what happened over in 2022, where there were questions around how much they would hike rates. And this article put together the 75 basis points that they then came through with. A real question here, and Jim Bianco pushing back this morning and said this is the opposite because it introduces that uncertainty. We don't know whether this is a steer or just simply a reflection of a debate that's being had in markets. Either way, is this the way forward guidance is being operated?
I want to be super clear. It's not the author's fault. I think the author has the envy of the world in financial markets when it comes to financial journalism with the access he has in the Federal Reserve. It's not the author's fault. This is the Federal Reserve's problem.
Yes.
And I think it is a problem, a big one, going into a big meeting.
If you want to signal something, say it in a speech. If you want to steer the market directly. If you want to do it through second channels and it's not necessarily clear, then you might be giving a different steer, and you're giving people an outsized degree of power to influence the market and alternatively, potentially the Fed's power. You're right, because this is something that was traditionally what they did. And here we have a situation where it's introducing more uncertainty.
It's muddying the waters. They want transparency. And maybe a journalist can ask Jay Powell about this at the press conference. If you want to go to someone with credibility this morning, it's Dudley. The question is, why don't you just get started? That's what he said. It's basically up to Chairman Powell to see how much support he has for being more aggressive. I take Dudley's comments with a lot more weight in terms of potentially them leaning towards 50.
Bill's been making this argument for a while. Neil Dunton's been making this argument for a while. If you're offside, let's get a move on. And I think that the point that Neil Dunton made around interest rates is an important one too. If you go 25 instead of 50 because you're worried about the signal, why cut interest rates at all at this point? I think that's a perfect point, a valid one.
It is definitely highlighting the lunacy of some of these arguments. At the same time, you can imagine that if they cut by 50 basis points, maybe the market would extrapolate in 150 basis points of rate cuts, because why not cut by 50 basis points at every single meeting? Look, you can come into a lot of different scenarios. As you've mentioned, the Fed can do a lot with the messaging, with a statement of economic projections. So it's not just about this particular move, but going forward, where the balance of risks actually
Wednesday is a three-part act. You'll get the decision, you'll get the forecast, and you've got a big news conference as well with Chairman Powell. Equity futures on the S&P 500 firmer by 0.2% on the S&P. In the bond market, we're shaping up as follows. Yields are a little bit lower, down a basis point on a 10-year, 366. On a 2-year at the front end of the curve, we're down 3 basis points to about 360. And foreign exchange showing a little bit of dollar weakness against the euro. Euro dollar at 110.80, a little bit more against the yen. Dollar yen down by 0.6%, Lisa, this morning.
And really, it'll be a two-part act next week as well, given the fact that we have the Fed conference on Wednesday and then the Bank of Japan rate decision. How much are they going to lean on what happens with how dovish Jay Powell actually is to decide whether they need to hike or signal a hike, or whether they can just leave it be?
Coming up on this program, Sinead Colden-Grant of BNY Wealth saying the S&P 500 can still climb into year-end. William Stein of Truist on the divergence among chip makers, and Troy Gajewski of FS Investments saying tech is one of the greatest growth stories in capital market history. ... because he's got things to say, so stay tuned. We begin with the big issue, the Nasdaq 100 heading towards its biggest weekly gain this year, going into the Federal Reserve meeting next week. Sinead Colden-Grant of BNY Wealth looking for the rally to continue. US exceptionalism continues. The rotation that started with a soft headline CPI print for June is a healthy broadening of the rally, bringing our year-end forecast for 2024 to 5,700. Sinead joins us now for more. Good morning, Sinead.
Good morning, Jonathan.
It's good to see you. So let's start with this call, because this week has been about big tech, not the breadth, not the broadening out, not about other sectors. In fact, at times, financials and energy have really struggled. Why is the bet beyond big tech?
Well, we're starting to see the beginning of the rate cutting cycle, as you were just speaking about. So whether we get 25 or 50, the point is that we're starting on the journey. So as we start to see a little bit more loosening of financial conditions, that's going to be helpful for equities broadly. One of the reasons why tech has done so well, setting aside the AI focus, it's been because of the amount of free cash flow that they've had, the fact that their earnings have been expanding so quickly. When we look ahead to the remainder of the year and also into 2025, so we're looking for earnings for the S&P for the full year to be between 245 and 255. And then higher again in 25, so 15% earnings growth in 25, getting us up to 280 to 290. So when you talked about 5,700, yes, that's right. That is the upper end of our range.
Okay.
So assuming we don't have a recession, that we do see a soft landing, you could even see markets slightly higher than that. And the other thing to remember is September is usually a tough month for markets. On average, markets fall about 1.2%. It's the broader market, the S&P, not the NASDAQ. But then you have almost a 3% rally in Q4. So looking at where we are now, that sets us up pretty nicely for 5,700.
Let's pick out a sector, the financials, the banks. It's been a really interesting week. JP Morgan's Dan Pinto came out and essentially said the analyst expectations around net interest income are too bright, too rosy, so everything's starting to come down. JP Morgan had a terrible day that day. That's based on the path for interest rates. Ally Financial came out and said the auto loan book wasn't great. That's based on credit deteriorating. What was your takeaway from the conferences this week, particularly the Barclays Global Financial Conference earlier this week?
Well, look, the path of rates is clearly important for net interest income. We are of the view that we probably see 25 next week. But undoubtedly, somewhere between 75 and 100 by the end of the year. What those two contrasting comments are focused on is the impact on the consumer, right? The reason why you're seeing some deteriorating credit quality is because the lower income cohort have been really feeling the pinch, not only from the higher rates, but also the cumulative effects of inflation. So at the margin, as we start to see rate cuts, that will relieve a little bit of that pressure. But when we look across various segments of the market, you've got the upper income cohort performing very well. They've got balance sheets that have expanded. Generally, their debt service cost hasn't really changed since 2019. So they've been insulated by 2.5%, 3% mortgage rates. But at the lower income cohort, when you start looking at, we focus on, our 2.5% CPI read year over year, the most recent one. But when you look at the cumulative impact and you start looking at individual segments, food, energy, et cetera, you're in the mid-20s for the cumulative impact over 4 years. You take all of that together, not surprising that on the auto loan side, you're starting to see some pressure.
When you put it together, it just is a sort of a contradictory signal that's hard for some of us to get our heads around, this idea that you could have a weakening economy, you could have a rotation towards some of the more economically sensitive stocks that are going to be susceptible to some of these shifts, the financials in particular. And you're projecting a gain of about 13% from here to 6,300 by the end of next year. What's going to lead that? If you do have these questions around certain aspects of the cyclical market, and you do have these concerns about the resilience, particularly of a whole cohort of consumers?
Well, first of all, by the time we get to the end of next year, we're probably going to have seen somewhere in the region of 150, 200 basis points of rate cuts. So that's automatically going to help with some of those more sensitive sectors. But let's think about the economy more broadly. And look, realistically, market participants, we can tell, have been finding it very hard to believe that we're going to see a soft landing. And you've seen that in the market reaction that we've had to softer data prints. When we look ahead to 2025, we think the economy continues to expand. So in addition to an upper end of 2 to 2.5% this year, we think we see a similar level of growth in the economy next year, which will underpin sectors more broadly. Now, if you look at one of the sectors that hasn't done well this year, relatively speaking, it's consumer discretionary. And as you start to see rate cuts, you'll probably see that start to do a little bit better. But broadly, when you look at earnings across the board, 2025 heading into 2026 is when you've got to start to see investment in AI impact productivity, impact earnings, and that's the other tailwind that we expect.
It's interesting, the sort of shifting story around AI, and that's actually something that's where I wanted to go. Can you get a 13% rally in the S&P 500 in the next 14 months or so without participation of some of the big tech stocks?
They're a huge component of the market. So of course, if we expect the S&P to be at those levels, the tech sector is going to play a significant role there.
Sinead, we've got to leave it there. It's got to catch up. Appreciate your time, as always.
Thank you, Jonathan.
Thank you so much. Sinead Colin-Grant there of BNY on this market going into this big Federal Reserve decision next week. As we keep on saying, three-part act. We get a decision in that statement. We'll get some forecasts as well, and a news conference with Chairman Powell shortly afterwards.
Which has leaned dovish consistently, and that's probably why Bill Dudley's comments got so much attention as well. Not only is he the former New York Fed, but he also is saying, can he bring the rest of the committee around to his view?
Is he the 13th member? of the FOMC. Equity futures on the S&P 500. Don't worry, Bill, we know you're not. We're up by 0.2% on the S&P. Maybe you'd like to be. I don't know. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Strategists at Bank of America, led by Michael Hartnett, are expecting stock markets to trade sideways until more clarity on the U.S. labor market. He wrote that a clear direction for jobs will, quote, resolve the autumn ambiguity. Hartnett also noted that stock funds had their largest weekly outflow since April, with $6.1 billion exiting the asset class, citing EPFR data. Meanwhile, investors continue to pile into cash. The New York Times just out with a report that Miami Dolphins owner Stephen Ross is talking with PE funds looking to sell a stake in the team. Besides the Dolphins, the transaction would also include a stake in the Miami Grand Prix and the Hard Rock Stadium. In total, Ross is looking to sell as much as 15% stake in the assets. Firms in conversation include Arctos Partners with a valuation above $7 billion, according to the Times. Elsewhere for the Dolphins, week 2 of the NFL season is underway, and the Buffalo Bills are riding high after easily handling the Dolphins in South Florida. Concerns are high, though, for Dolphins QB Tua Tagovailoa after he left the game with a concussion after diving for a first down. That's his 3rd concussion in 4 years. And that's your brief, John.
Yeah, that's not great. That's not great at all. Danny, thanks for the update. Appreciate it. More from Danny in 30 minutes' time. Up next, the Morning Calls plus William Stein of Truist on the outlook for chips. That's just around the corner from New York. This is Bloomberg.
Was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Andrew Honhorst of Citi with this to say, 25 versus 50 remains a close call. Articles in the Financial Times and Wall Street Journal keep the prospect of a 50 basis point cut next week on the table in our base case. The Fed cuts 25 next week, followed by 50s in November and December. But he says the story's not over. Next week, weak enough retail sales on Tuesday could push the Fed to cut 50. I think we all just want to see the back of this meeting next Wednesday, don't we?
I couldn't agree more, considering the fact that we thought we were getting most of the economic data that was relevant this week. Now, retail sales is the new Michigan Sentiment Survey.
Let's see what we get. Let's turn to the bond market. Price action looks like this. Yields are coming in, down 2 basis points on a 10-year, 365.51. At the front end of the curve on a 2-year, down 4. It's a break of 360, just about. 359 leads through the front end of the curve, unlocking some dollar weakness on the margin again.
on the morning.
And this, to me, really does hinge very much with 25 or 50 and whether the market can extrapolate in an additional 100 basis points of rate cuts after that. Key question to me is just how much people are underweighting the possibility of the ECB actually saying, hold my beer, considering the fact that their economic outlook is negative and they did downgrade it further in the economic projections yesterday.
I keep saying this, if the Federal Reserve delivered the kind of guidance that the ECB do, can you imagine the kind of reaction? The growth profile in America is better than what we're seeing in Europe. Inflation is basically in line. Europe versus the United States, not quite apples for apples, but you know what I mean. And we've got an ECB saying, meeting by meeting, 25 now won't tell you anything about next time, a mystery. Let's see you next time. And the Federal Reserve was sitting here saying, oh, 50? What about next time? And the one after that? Show us a string, show me a dot plot. Talk to me about the destination. Where are we going?
If the Fed were going to do what Christine Lagarde did, you would see a massive sell-off in equities, led by those same small caps that might be the ones that get the biggest boost from the rate cuts right now.
Futures outperforming on the small caps this morning. Time for the morning calls. First up, JP Morgan cutting Moderna to underweight from neutral with a lower price target of 70, down from 88. The analysts saying quarterly results are not likely to surprise to the upside. Your second call from RBC, downgrading Halliburton to sector perform from outperform with a lower price of 37 from 44. The analyst citing disadvantages in a tepid commodity macro environment. And your third and final call, BNP Paribas downgrading Micron Technology by 2 notches to underperform and cutting its price target to a street low of 67. The analyst warning the stock will continue to underperform others in artificial intelligence. Divergence growing in the semiconductor space between the likes of Intel and NVIDIA. A theme to watch. William Stein covers semis and AI for Truist, and William Stein joins us now for more. William, let's get to that. The divergence that you're expecting, that theme, can you just build it out for us a little bit more?
Sure. Well, we didn't write a note on this recently, but certainly we have a view that semis are in an upswing in aggregate, but the end markets and products are seeing very divergent trends, right? For at least a year, we've seen these broad-based end markets like industrial and automotive and those end markets sort of drag. And, I think for folks that are just looking at companies that serve those end markets, you might say we're in a downturn and maybe at the bottom. But meanwhile, those who are very focused on the AI-linked names, you're seeing tremendous growth. In aggregate, it means that we've actually been in an upturn in semis for about a year and a half already. And, growth is quite good, but it's very much a story of haves and have-nots, with the AI-focused companies led by NVIDIA doing very well and many of the others seeing fundamentals trough.
Well, I do wonder then what you make of the recent volatility in NVIDIA shares. We saw just a comment from Jensen Huang coming out and saying that people are feeling really anxious, nervous. There are emotional conversations about getting their deliveries. That was enough to boost the stock by more than 13% in just a couple of days. What do you think the signal is from the volatility in shares of such a massive stock?
Yeah, I think it's maybe an over-discussion. I think that's the best way I could describe it. An over-discussion by investors who are not sure and not perhaps long-term enough in their thinking on the trends that are, so powerful for this company. AI is one of 2 major trends that NVIDIA is experiencing. The other is a shift away from serial compute to parallel compute. That's a bit of a technical issue, but the big application there is AI. The demand is very strong. We think it's going to remain that way for some time. We think the return on investment opportunity for companies to build out these systems is very robust. And that's where the discussion tends to focus, right? Is, we're spending billions of dollars. Are we getting anything out of it? And are they all going to stop spending next year somehow? Our checks for some time have reinforced a view that 2025 is going to be a very strong growth year for NVIDIA, not just for